Ladies and gentlemen, dear President of Better Finance, Heinacher, dear Member of the European Parliament, Heinäluoma, dear panelists, ladies and gentlemen. On behalf of Lucia Puttrich, Minister for Federal and European Affairs of the State of Hessen, I would like to welcome you in the representation of the State of Hessen to the EU. We are particularly pleased to host Better Finance International Conference on the EU Retail Investment Strategy today. Its subtitle, Towards a Capital Markets Union that Works for People, refers to the new thrust that the CMU policy took on in the 2020s. When the first designated as a flagship policy in 2015 by the Juncker Commission, CMU was aimed at integrating and deepening capital markets as an alternative source of financing to the predominant and crisis-prone banking industry. The first CMU Action Plan brought significant measures towards market integration. Nevertheless, European capital markets remain fragmented, home buyers is strong and retail investors' participation remains low, especially compared to the US. Thus, EU households hold an average of 17% of their asset in financial securities compared to 43% in the US. Much remains to be done to achieve capital markets as vibrant and efficient as those across the Atlantic. Consequently, the von der Leyen Commission put a stronger focus on retail investors. The Retail Investment Strategy and its legislative package is the outcome of that new focus. It aims at empowering retail investors to make investment decisions that are aligned with their needs and preferences and get a fair share of the economic outcome. Ladies and gentlemen, the State of Hessen could not agree more with this policy aim. To Hessen and its financial hub in Frankfurt, with its strong stock market and investment and security industry, initiatives to broaden capital markets are welcome. Strong and efficient capital markets will enhance overall financial markets performance, reducing financing costs for the corporate and public sector. It will increase economic growth and the green and digital transformation of the EU economy. We also firmly believe that regulation should not only aim at investors' confidence as a means to the end of achieving deeper capital markets and cheaper financing for firms and states. A regulation that works for the people should be about retail investors' empowerment as an end in itself, allowing retail investors to make more informed choices and profit from higher yielding investment opportunities rather than keeping their savings in low yielding deposits for the banks to manage. Ladies and gentlemen, the proposals will have to be thoroughly studied and discussed in the political process. We believe that open discourse and the exchange of arguments will bring about good solutions. It is of the utmost importance, however, that not only industry but also retail investors' interests are adequately represented in that discourse. We are therefore particularly happy to host this conference organized by Better Finance, the European Federation of Investors and Financial Services Users. And now, before I hand over to President Heinacher, I want to thank Managing Director Prache and Mr. Houdemont for the excellent cooperation to prepare this conference, and would like to thank my team, Mrs. Seehafer, Mr. Golaczynski, and my colleagues from the Technique, who has prepared this conference. Thank you very much for your attention. President Heinacher, the floor is yours.
So let me first of all thank Friedrich von Heusinger for welcoming us here in this wonderful place, the representation of the state of Hessen. And we are very grateful that you are our host all day long. And to be very honest, we love this place here. And we just heard there's also a wonderful rooftop that we can use next time. So I think he deserves a big applause. Thank you, Mr. von Heusinger. Ladies and gentlemen, I have the honor to open today's conference here in Brussels, I think with an exciting topic, the retail investment strategy, And I think we have wonderful guests and very interesting keynote speakers. We are looking towards a day of interesting discussions on sometimes also debatable topics, and in the focus stands the RIS, just published by the EU Commission. And of course, I would like to take the chance and briefly comment a bit upfront on this once-in-a-lifetime opportunity to create a capital markets union that works for people. Yes, we at Better Finance, the European Federation of Investors and Financial Users, we welcome the retail investment strategy. We believe it's a step in the right direction. Despite certain positive advancement, we see, however, that it falls short of fulfilling several of the key objectives in enabling EU individual investors to benefit from. Well, what am I talking about? It is all about bias-free advice, coherent rules across legal instruments, transparent and comparable information, and open markets with a variety of competitive and cost-efficient financial services. We at Better Finance welcome the proposals to extend the ban on inducements to insurance-based investment products, so-called IBIPs, and we welcome the ban on inducements in case of execution only, non-advised sales of investment products. These are two measures Better Finance strongly advocated for. Nevertheless, this specific ban on non-advised sales seems to apply de facto only to the small minority of MiFID-regulated products, and the proposal allows member states to prohibit non-advised sales of the much more widely used life insurance and pension products. In relation to the PRIPS key ID, the key information document, we as Better Finance identified several key concerns which are still unresolved. These include the lack of measures to address the issues of comparability and comprehensiveness, as well as the pseudo-science of disclosing non-comparable future performance projections. Despite the positive focus on digitalization in this proposal, retail investors still urgently require clear and comparable disclosures of actual performance and of costs. Now, I don't want to go too much into detail. If you want to know more, you should take a close look at our recent report on the progress assessment of the Capital Markets Union, and I can tell you it is worth to take a look at it. We can only, as organization, urge European and member state policymakers to improve the proposal and take more of the original objectives for the retail investor into the focus. And again, I think we talk about restoring investors' confidence in the industry. We talk about achieving greater choice and access to suitable and cost-effective products. And finally, we talk about enhancing retirement savings, in particular by creating a successful European market for simple, efficient, and competitive personal pensions. Well, ladies and gentlemen, I'm delighted that we have two of these key topics also in the center of our panel discussions today. And I'm very impressed, I think just like you, to see that we have such distinguished guests today. And we have them, and that's what I think is really notable, well balanced from all sides. We have the EU Commission, we have ESMA, we also have national supervisory authorities, but we also have the sales side. we have Allianz France, we have Vanguard, Schröders, Deutsche Börse, Nasdaq, and even Trade Republic as a smart broker. So let us get started, and I would like to welcome our first speaker of today, the first keynote speaker who will open the conference. It's the MEP and member of the ECON committee, Eero Olavi Heinäluoma. I hope I pronounced it right. So let us welcome Eero. The floor is yours. Thank you very much.
So, ladies and gentlemen, good morning, and happy to be here today with you. Really, I have to congratulate Better Finance for organizing this together with the representation of the state of Hessen. Our conference is really at the right time because the Commission has published its proposal, and now it's time for discussion, and then afterwards also the decisions from both from the Council and from the Parliament. And then also I would like to congratulate you for the title of this conference. It's really wonderful because it tells what we ought to do towards a capital market union that works for people. It really summarizes pretty well what should be the ultimate policy of also this legislative package. And we all know that we are lagging behind results, especially concerning the capital market fulfillment of capital market union. And this title of this conference also resonates with the words Commissioner McGuinness said during her confirmation hearing in the European Parliament in October 2020. When she made a real important promise, she would put people at the heart of the financial system. And this would be a priority for her, and this message was very well received also in the Parliament among all the political groups. And really, this is needed because we are lagging behind our targets from several years. The key problems of the European economy is the lack of retail investments. Too much savings on the bank side and too many small funds, too much fragmentation and different tax treatments, etc. So it's clear that there are several reasons for this reluctance from citizens to invest their savings. However, a lack of trust is one of the key reasons. And as a consequence, according to a recent European Commission scoreboard, the retail investment market is considered as one of the worst performing markets for consumers in the European Union, which is a very sad thing. And then, of course, this also means that we have great possibilities if we are ready to change the rules of the markets as they are now, because it can give a straight and important positive signal for the future success of our European Union. Therefore, one of the main objectives of this retail package is to ensure that retail investors can invest into financial markets with sufficient confidence and trust. And I suppose we share the analysis of the problem. Does this RIS package meet then expectation and brings any effective solutions? It's clear that there are interesting ideas in the package, like addressing the role of financial influencers, improving financial literacy, really important things where we can do things better. But there is also some things which are still lacking. The package is a little bit disappointing as it fails to tackle one of the main problems effectively. Yes, it's positive that the Commission acknowledges that there is a serious problem due to the biased financial advice in the European Union, Indeed, its own assessments clearly conclude that an EU-wide inducement ban would be the most effective measure to end potential conflicts of interest and protect small investors. Nonetheless, despite some potential interesting measures, the Commission failed to tackle the real and big problem by not proposing a full ban on inducements. As we know, inducements are benefits or commissions that are paid by third parties to advisors for recommending their products to clients. There has been a long concern in Europe, stemming back from the original MiFID II discussions a decade ago, that inducements payments by asset managers and insurers to financial advisors can lead to biased advice that is not in the best interest of retail investors. Since the original MiFID II discussions, there is now even more overwhelming evidence that inducements do lead to conflicts of interests that have a clear and negative impact on the quality of advice delivered to consumers, with higher cost investment products routinely recommended by advisors to consumers for the higher commission payments they generate. In this discussion, it's always worth looking into the dry facts. Products on which inducements are paid are, on average, about 24 to 26% more expensive than investment products on which no inducements are paid. So, 24 to 26% more expensive. Furthermore, the conclusion of the recent study of the Regensburg University are also crystal clear. There is an annual return difference of household wealth between 1.5% to 2% for OECD countries with commission ban versus OECD countries without. This implies that after 40 years, households in commission ban countries can have closer to double the amount of wealth compared to households in non-commission ban countries. For Europe, as a result, results indicate an annual household wealth loss of 375 billion euros, an annual wealth loss of EU households of 375 billion euro due to the inducements. It's an astonishing figure. You would think it's pretty good reason to go further, the logic option, and propose a full ban on inducements. And yes, there are precedents which clearly show that the financial sector can survive without inducements. In the Netherlands, inducements were banned following the global financial crisis, and financial advisors can no longer receive inducement payments, and they are required to charge an upfront transparent fee for the cost of advice to clients. The result in Netherlands, the level of trust in financial advice has improved, the quality of financial advice has improved, there has been a shift towards advisors recommending less expensive products, resulting in better value for money for retail investors and improved returns. More diverse products are being offered to consumers, including ETFs and index funds that often do not pay out commissions to advisors. Overall, looking at the financial sector in the Netherlands, I do not think you can call it surviving. Despite this kind of clear examples, as well as the example from the United Kingdom, still a full ban on inducements is not deemed necessary by the Commission in this package. Of course, we all have witnessed over the last months an evolution in the stance of the Commission on this topic, following quite a massive campaigning from parts of the financial industry and also supported by some member states. But still, this is an open thing which needs a careful looking and also very thorough discussion during the next months. The defensive attitude from the financial industry is not only highly regrettable, it will also be counterproductive to my eyes. As Europe, we just cannot afford to keep making big statements about the need for a capital market union, but then at the same time keeping shy away when serious reforms should be put on the table. At this rhythm, the European Union will keep talking about the need for a well-functioning capital market union also in the coming decades. We have to take seriously our words and speeches earlier about the competitiveness, importance of competitiveness, and also the importance of free markets. And that means that we must be ready to look once more on the question of inducements. In a fair and free markets, financial advisors would choose products not for the commission payments. Financial advisors would choose products not for the commission payments they generate, but for the quality of the investment product offered. Let free and fair competition play, and it will be ultimately lead to a better value for money investment products and attract more retail investors to remain invested in capital markets. And then, of course, we are in a problem because we got the proposal from the Commission for the new strategy quite late. I suppose perhaps due to the problems on the preparing it, and especially on the different opinions concerning the inducement ban question especially. The Commission has commissioned several studies over the last years, and in all of these we can see the problems around biased advice, so they are not a new thing for us. Improving life for retail investors is a real topic for all of us, and I hope that the Commission is ready to look this once more, and the Parliament ought to do also the job on its side. We all want a retail investment market in which consumers can invest with confidence, understand the risks they are taking, and the regulatory protection provided. Firms should be able to better support consumers with simple needs and enable them to make effective decisions on whether and how to invest or not. Key to this is ensuring that consumers can get the advice or support they need. So, the retail package as it stands does not meet all the expectations, and of course, it proposes, if not the best solution, the second best solutions, like more transparency, some measures around value for money, a ban in case of execution-only sales, some standardization requirements. I have no doubt that these measures could have some merits, however, they will not be as effective as the real thing, a full ban on inducements. As MEPs, we must be ready to hear all the stakeholders here. The industry in the European Union is very powerful, and it's a good thing that their voice is heard. But we need also the voice of consumers. So I hope that you will be active in this field and you will take your share of the influencing when the decisions are made. Therefore, with the colleagues cross-party in the Parliament, we will do our work and we will work towards considerable improvements for this proposal to make sure this package does not what it is supposed to do to effectively improve life of retail investors. If we are serious with the EU economy, with the need for more private investments for our green and digital agenda, it's evident that we have to bring a full ban on inducements back to the negotiations table and to be ready to look at it once more. So I hope to hear your proposals and your analysis during the next months and also in this conference. And I hope that this conference is a little bit the same thing as the Midsummer Festival in Finland, which brings more light to the decision-making process and happiness for every people. Thank you.
Of better finance. Thank you very much, Mr. Heinäluoma, and without further ado, to continue the festival you started, I will call on the first panel, which is moderated by Karel Lano, and it includes, and we are extremely honored and pleased, it includes the DG FSMA himself, John Berrigan, who has kindly accepted to participate himself to the panel. So, welcome them, please.
Thank you, and good morning. I think the tone was already set by Jelle and Eero about the main subject of discussion in this panel, bias-free advice and access to competitive and cost-efficient products. I think we have a great panel. We have two regulators, or a regulator and a supervisor, then 3 market participants, and we have also represented from Better Finance, so that will be an excellent set, but also amongst the market participants, rather different views, I expect, so we will hear this in a moment. As Guillaume said a moment ago, we're very happy that John could make it, but also happy that Barbara is here, let's say, to have this point of view from the Netherlands, which is great, because the example of the Netherlands was already mentioned, but unfortunately, Netherlands' example was not sufficiently convincing, apparently, for the Commission, let's say, to take it up, to go for a full ban on advice. So, we'll start with, let's say, each of us, let's say, giving about, say, 3, 4, 5 minutes, let's say, introduction on how they think, let's say, we can move to bias-free advice, how we can move to better products as for consumers, and how we can eventually exploit the potential of having more of such products, because don't forget, in Europe we have far too much money on deposits and far too little on investment funds. A lot could be much better invested, and if it's better invested, could provide for better savings for all of us, let's say, but also for the long term, for retirement. And that's in this perspective, let's say, that we have to look at this proposal. John already, a moment ago, Eero said, let's say, he was a bit disappointed by the proposal that, let's say, what will be kind of inducement-free is in fact limited to a very limited set of products. So how do you look at this? How do you look at this entire debate, let's say, and how do you look at the proposal which is on the table? Also in this prospect of these broader things which are also mentioned, or CMU is about 9 years old now. And if you ask many people in this room, certainly privately, they say, well, we haven't seen enough of CMU yet. Certainly on the market impact of CMU was not sufficient. And this proposal, in fact, is crucial in this regard. But it also comes, as Eero said, fairly late. So a bit the question is it a bit too little and a bit too late?
Thanks for the introduction, Carl. When I entered the room and I heard the speaker, I realized that, as usual, the Commission has disappointed everybody to some extent, which is normally the sign of success in a Commission proposal, but we shall have to see this time. I mean, what I wanted to say here is just to... I mean, I assume people are familiar with the contents of the proposal, so perhaps it's better to talk about why we did it and why we did it the way we did it, rather than go through in too much detail what we have put on the table. I think, as being said when I came in, this is not just an investor protection discussion. This is a capital markets union discussion. So if you look at the CMU Action Plan, you will see that the retail investment strategy is part of that plan. Why? Well, because, and this you're all aware of, we are pretty good savers here in the EU. We put the money away, but we put it away in deposits primarily, and we do not put very much of it into the capital market at all. In contrast to the United States, where the numbers are exactly the opposite. So 70-30 in favor of deposits here, 70-30 in favor of capital instruments over there. What we noticed was that in the first action plan we did in Capital Markets Union, we focused a lot on supply side. Didn't think too much about the demand side. But, you know, Economics 101 tells you you can't have a market unless you have two sides. So this time we decided to focus on the demand side as well, and of course that is the retail investor. And those of you who know me from my long distant past will know that I have often not focused too much on the retail side, mainly because I have believed in the trickle down. You get the wholesale right, it will trickle down. This time I had a look, and guess what? It's not trickling down, at least not trickling down quite the way I expected. So I think there are sort of two reasons to do this. One is for investor protection, to make sure it all trickles down, but also to build the capital market. Now, why is it that we don't, in the EU, save more in capital markets? Well, I've been on many panels, and I think I was on a panel with you, in fact, where the central thesis was that the United States, there's a sort of forced activity in capital markets because of the 401k system. You're simply forced into it. And in Europe, you are not. And then very often, since you do not have the same private pension provision, there is no sort of urgency, no pressure on you to come out of deposits and make more money. This is probably true, and I'll come back to that in a minute, because this is one of the reasons, perhaps the less exposed reason, why we did not go for the full ban. But what we know is that most people in the EU, if we're to bring retail investors into the market, will come via intermediaries, and today they will come via an intermediary that is selling based on commission. That's the standard model. This is and creates a prima facie conflict of interest. As I've said before, if Carol is being paid to advise me, is he advising me or is he working for his paymaster? Maybe he's very good, very honorable guy, he works for me, but maybe he also has kids and university fees, so he has to basically make a living. So this is the prima facie conflict of interest. I don't think anybody can deny that exists. The question is, how do we address it? We would normally address conflicts of interest, and we have many of them in the system. I mean, we face conflicts of interest across the financial system, and we address them through the standard method of transparency and disclosure. So I tell you, I have a conflict of interest, and then you can decide whether I'm managing it well enough or not. The little wrinkle here is that we have this conflict of interest in conditions of information asymmetry. So you have the financial system versus the retail investor, and the retail investor doesn't know. First of all, he may know that you're being paid an inducement, or he may not. He may understand if you tell him, or he may not. And he may understand the implications of inducements for him, or he may not. And so the question is, how do we fundamentally address this issue? A lot of attention was paid to the perhaps the most direct way of addressing, which is simply ban it. I have interesting conversations with Chinese regulators around crypto. They just prohibit crypto, and they say this is excellent regulation. It's very smart, simple, clear, one line. You shall not use it. It can be useful in parts, but sometimes these kind of simple approaches are not as straightforward as they look. So, of course, the full ban was on the table. We were considering it. But we were, I think, influenced by two things. One is the story of disruption and excessive disruption. And this was a story made to us by the industry in many letters and in many representations. And I think there's something to it. The industry has built over years on this model. To ban it overnight would have been highly disruptive. So this was one of the things we took into account. Of course, I will make the point that everything we do in my line of business is disrupting the financial system to some extent or another. So it's a matter of how you manage that disruption. But it certainly was a consideration that we took into account. The other consideration we took into account was the so-called advice gap. Now, I have an issue with the term advice gap, not with the gap part of it, but with the advice part of it. But on my visit to the UK, it was clear to me that they, having introduced the ban, have an issue around a gap. Something is missing in the system. They're trying to solve that now, but it's proving not to be so easy. So the issue then is, let's start with the advice part. We know with the conflict of interest, it's not advice, it's sales. But there may not be an advice gap, but there may be what I would call a solicitation gap. Because what we want to do here is to create a situation where you have an investment advisor like your doctor. So the doctor takes care of your physical health, and your investment advisor takes care of your financial health. The problem is, you know, when you go to your doctor, you have a sore leg, pain in your head, you go to your doctor. You may not know you should be going to your investment advisor. So there is this sort of sales gap, this solicitation gap, which we have to think about. The question is, however, the terms on which that solicitation is made. And it's very important that if we have a solicitation, that the retail investor understands that he's basically not getting advice, he's getting a sales pitch. He's being sold a product that somebody is being paid to sell him. Nothing wrong with this. We all buy cars. The car salesman sells me a car. I know he's being paid to sell me the car, so I can discount the bits of what he says I don't want. I don't need the big tires, I don't need the big engine, I don't need the leather seats, so just don't bother. But I know I'm being sold something. So this is where I think this is a much more difficult problem than perhaps people think. It certainly cannot be handled by the status quo. The industry has been given excellent advice according to itself for decades, but I still only have 30% of people in the capital market. What's wrong with the other 70%? So the status quo cannot hold. On the other hand, the straight ban may be just too disruptive and may create this solicitations gap, this absence of the sales pitch. I will not use the word advice until we decide whether it is advice. So this means the solution is much more complicated than just straight bans. So clearly what we have done is say where there's no advice or no sales pitch, there can be no fee. So this is the partial ban. No advice, no fee. Where there is advice or sales pitch or whatever we want to call it, we're going to have to work on ways in which we can ensure that that sales pitch serves the client and not the product manufacturer. And that's what we did in this proposal. We focused on various aspects around the ban. So value for money, enhanced disclosure rules, better retail marketing rules, ways in which we can make the retail experience better, but without the full ban. Will this work? We hope so. We certainly think it has a chance, but it requires the industry to engage with us. And I have to say some of the letters we have received since has given the impression that the industry does not want to engage with us on this. So it is important that the industry understands that the status quo, as my boss has said, is not delivering what we want. So the status quo cannot remain. We have to together fix it. That is why the ban, of course, remains on the table in the form of a review clause, because if all that we do here doesn't work, well, then we have to go back to think again. But for the moment, as I said, we did not come down with either of the simple solutions, leave it as it is, or the total ban. We've opted for something that's perhaps a bit more complicated, a bit more difficult, but I think in the end, if we get it right, maybe the best solution. Thanks.
Thank you, John. We see, let's say, the issues you're confronted with on, let's say, bringing out this proposal, and we haven't even addressed all the issues behind it, but that's why probably I turn to Barbara now, let's say, just to see how you look at it from the Netherlands. I mean, no need to repeat, let's say, the whole argumentations on the ban on inducements, which I think the argumentation is well known, but how do you look at the Netherlands on this other objective which we have, to have a coherent set of rules across the EU? Because one of the additional problems which we have is that we have an extremely fragmented market. And if you look at the data on cross-border provision, of course, it's a bit distorted because of usage, but basically products are designed for a national market for a whole series of reasons, not necessarily for a European market. And the fact that the costs are high is also because our markets are extremely fragmented. How do you look at it from a Dutch perspective? Barbara, and thank you for joining us this morning.
Carol, and I think it's actually a good question. And well, let's get back to the cost point and then a little bit later. And thank you, Sean, for the good proposals, because there are so many good proposals in the retail investment strategy that I've seen. I think what I've seen in the proposal, In the proposal for simple advice, I think it can even be a bit more simple to allow people to access capital markets in an easy way. I think that's the purpose we all share and a goal that we all underwrite, that we need to get right with the retail investment strategy. I think the proposals of aligning marketing requirements more with the current times, the digitalization, and also put the responsibilities of the marketing there where they belong is a very good step into the right direction. The ban on inducements of X-only, well, it's logic. So from a Dutch perspective, I don't have to go into it. It's a good step in the right direction. And then but, and everything for the but doesn't count, but in this case it does. I think it's a missed opportunity that we have. I heard it already in the speech of Eero before. I think one of the key issues now currently in Europe is the problem with biased advice that is there for clients. And we had this problem back in the Netherlands, so I will take you back. I joined the AFM 12 years ago. I only like to think it's a coincidence that 12 years ago we announced a ban on inducements in the Netherlands. We had a huge mis-selling scandal back in the days. Insurance-based investment products were sold to clients. Advisors didn't really understand the products that they were selling. The cost of the products were so incredibly high that, in fact, you could, if you do the maths, it would require an incredible return on the investments themselves to even make a little bit of money. I hope this is not this extreme in other European countries at the moment, but I'm quite concerned if I look at the stats and of the cost statistics that are there. Also see it in the Commission analysis that it's not only the provision of information and the information asymmetry there, but it's also the costs. So people then always say, well, just advise the cheapest products. That's not what we plea for. We think that it should be a good product. And there's so many good products with low cost levels that also serve a lot of investor needs. Maybe there's always a lot of misunderstanding what the ban on inducements is in the Netherlands. So we have a prohibition to pay or receive inducements. This prohibition is both for the advisors and for the financial firms. So they're not allowed to pay or receive any inducements. That means that the client who actually gets the advice is the one who pays for the advice. We did not set any rules on how this payment needs to be done. There is a misunderstanding that you have to pay this up front and that already makes a barrier to enter the advice. This is not such a thing in the Netherlands. There are many different ways in how this payment is done. You have monthly fees, you have a top-on, you have several ways of spread your payments over time, and it becomes, well, it becomes like the inducement, then only it's paid by the right person, if you'd ask me. So this is something that we have. We don't prescribe the way it's paid, so we see different forms. And what we saw in the Netherlands after the ban was introduced is also that the market changed significantly. We've seen these tangible results there. What we saw indeed is these different ways of distribution to clients. There's still room for improvement. Even in the Netherlands, there is room for more people entering the capital markets. But what we saw is a change in distribution models, for which we as a regulator are quite happy. And the other thing that we will see is a change in the kind of products that were offered to retail clients. So the more complex, the more high-cost products that we saw in the marketplace disappeared, and we saw a significant increase of ETFs and the more simple products that for a plain investment objective would really serve its goal. So this is something that we were very happy with. We also see a restorage of the principal-agent relationship as it should be. So, well, of course, Dutch were surprised on how much they have to pay for their advice. And I can tell you something, the Dutch are always cheap. I'm one, so I know that. And we don't like to pay for anything. So even our dentist bill, we rather not pay because that's expensive. So they were surprised by the costs of advice there at first. We have done a lot of studies together with our Ministry of Finance, but we did not identify this as a reason for people not taking advice. So the advice cap that some people mention as an argument why there should be no full ban of inducements, we don't have the experience, and we have 10 years of experience with the upside of the ban on inducements. We saw a significant lowering costs of the products being offered to clients. I think ESMA did a study on this, on the costs and performances, and they saw that in the Netherlands, average cost is 0.57%, EU average is 1.47%. It may not may not sound like a lot, but I think you are all very well aware, if you do the maths and you accumulate this over a couple of years, there's an awful lot of advice that you can buy from that. And especially if you compare it for cost levels in the US, this is something where you can beat up, because if you lower the costs of your investment, people will have a little bit more at the end of the game, and that makes it more attractive to join the capital markets there if it's actually something there. The other argument I usually hear, and you touch upon that as well, is that there is not such thing as free advice. The advisor has a salary, has a university, kids, I don't know, and he has to pay for something. So somebody pays for the advice. We always say that free advice does not exist. Maybe from your neighbors if you had a couple of drinks, but I'm not sure if that's the advice that you should follow. But free advice is neither free nor advice. This is something that needs to be clear there. Advice can only be proper advice for the retail client if he's the one for who the advisor is actually working. That's for the experience that we have in the Netherlands, and I'm very happy with the first step of the proposal now on X only, because there is no advice there, so why should we have inducements there anyway? I think for the insurance-based investment products, there's a lot of room for improvement there as well. And what I do hope is that I don't have to, that the other proposals that are in there will make a change, that we don't have to dust these arguments that I have and change the stats and change the figures. And in a couple of years' time, we will still see, this problem is not solved yet. There's still room for improvement. And then we get the full ban. It's a bit of a pity that I understand we don't want to have a sudden shock. But on the other hand, sometimes we need a little bit of bravery to really address the issues that we see. Thank you.
Okay, thank you, Barbara. Thank you for these insights. And from a Dutch perspective, let's say how we see the market functioning. And as you're saying, they say even in the Netherlands, there's still room for more provision of these kind of services to consumers. We turn to one of the cost competitors in the sectors, Vanguard, which is well known, let's say, Eero was speaking about this is a market where one of the worst performing services market in the EU, which is basically a quote from a study which was done for the Commission, I think, in 2018. And we still are struggling with this problem. But in the US, let's say, we have perfect price competition in investment fund markets. How do you look at this from the United States or from a big US provider, let's say, in Europe, let's say, and which are the barriers which you see in getting price competition? Rabun, sorry.
Thank you. Thanks for the invitation today. Thanks for Better Finance putting on such a great conference, and happy to be here to share Vanguard's perspective. As you mentioned, we have competed for a very long time in global asset management markets as a cost leader, talking about the importance of low-cost investing. And just to give you a little bit of background on Vanguard, we were established 50 years ago in the United States and launched quite differently for an asset management company. We were launched as a mutual, so we're owned actually by our US investors. So what we think about as profits, rather than paying away to third-party shareholders of our company, we return to our own investors in, lowering their fees, improving their services, etc. We launched the fund company 50 years ago with an average fund price of 0.6% 50 years ago. And the price now for United States investors would be, on average, less than 0.1%. In Europe, we have been around for 25 years. We don't have the scale of our United States business, but nonetheless, we're here offering predominantly index funds and ETFs for 25 years to European investors, and we really focus on this retail market. It's very close to our heart. We were established to take a stand for retail investors and to give them a great deal, give them fair access to low-cost products so that they can, in fact, keep a lot more of their own investment returns. So one of the points that was mentioned by the opening speaker was the importance of trust in the industry that we're in the wealth management, if you like, financial services industry. And I think our approach has really meant that we are a leading brand with trust as a factor when we study the brand. It really has generated trust to take this low-cost, very transparent, no-nonsense, simple, back-to-basics approach. And you might think, oh, investing's complex. What's the, is it too simple? What they do at Vanguard is an ETF or an index fund too simple? Well, in fact, it's really steeped in empirical evidence, and we publish academic studies really to show just how this is the starting point and, often ending point for what most people need to construct an investment portfolio, broad-based diversification and very low-cost fees, and you will really achieve something over time. And that, I think, to understand is really a mathematics question. If you think about what you can expect from a diversified portfolio invested sensibly into capital markets, equities and fixed income, maybe sort of 7% is a good expectation over a long run return. And what you don't want to do is give 50% of your return, the risk you've taken, away to providers. So what we really aim to do is to keep a fraction of that to pay for the services we provide. So that's, if you just think about the mathematics of that, that's important to understand. We also are really strong believers in the value of financial advice. So we are not believers that advice isn't important. In fact, we see it as hugely important, but it needs to be transparent in the provision of its service, and it also needs to be low cost, because again, it's going to eat into whatever money you want to be keeping for your retirement or whatever your savings goal is. But the vast majority, by far the vast majority of people are investing to secure a great retirement for themselves. That's the goal for all of us, that we can retire and have a nice retirement one day. These are a really complicated set of questions, and we congratulate you, Sean, and your team for really thorough work and the recommendations. We have, been quite vocal on the benefits we think a full ban on commission payments would bring to the industry, that it brings this non-biased sales approach. Yes, it's disruptive, but hey, in business life, you're going to be disruptive. At the moment, we're all grappling with how AI is going to significantly disrupt our businesses, and how quickly that has really come into the fray since December last year. Disruption is a fact of life, and if it is disruption for better outcomes for consumers, you should have a great business model at the end of that as well. We all have to keep adapting. I think the only thing I would say is, we compete in global markets, and while we don't have all the answers to the policy challenges in Europe, Europe is leading the world in so many ways with policy developments and things that are happening here. But on this front, on retail investing and advice, it is not. It's a laggard, as we would see in other markets that we compete in. So what we do think, look to markets like the Netherlands, like Australia, like the United Kingdom. The United States does not have a ban on commission payments, but has evolved to a very strong fee-for-service market, and I'm happy to expand on that later in the panel discussion, because I think it's not simple. The solution is evolving. As Barbara mentioned, it's not once and done. The UK continues to work on it, and we will evolve to a better model over time, but it's great to see the start we're making.
Okay, thank you, Robin. Thank you for these insights in how the US market is functioning, but we can come back to that in a moment, as you said, on this issue of price competition in the European market. We have somebody from Better Finance, Alexandra, to take the floor on a consumer's perspective on this market and what is not functioning well and why is it not functioning well, and so how could it function better, or how could we serve consumers better? Alexandra.
Yeah, thank you very much, and thank you to everybody who accepted our invitation to join the panel in the conference. From our perspective, and I would agree very much with what Eero said, we were disappointed there are very many very good elements in the proposal of the Commission, but we were really disappointed not to see the ban as the main element of the proposal. because, and this has been also mentioned in the discussion already, we have not a real functioning CMU, and this has been confirmed by Better Finance study that we published on the 24th of May, where we assessed the progress of the CMU, because the consumers, investors are not really investing. And one of the reasons for that is that they don't trust the capital markets, they don't trust the financial markets. And the recent EU barometer is clearly saying that 45% of consumers are not convinced that the advice that they are getting is really primarily in their best interest. So there is a really serious problem of erosion of trust in the EU. And we really think that the main two elements that should have been addressed properly in the proposal would have been the bias-free advice and the coherent rules across different categories of financial products. And with the bias-free advice, we, as also Robin said, we really believe in the value of really good quality advice. And advice gap was mentioned today already. But actually what was the reason for the advice gap that was identified by the UK FCA for the people that FCA thought should have get advice but they didn't get them, respectively I think 9 and 11% of the respondents said that they didn't go for advice because first of all they were concerned about the low quality of advice and also they didn't trust really the advisors. So I think this should be really addressed properly. And we also thought that retail investment strategy should be designed and really address the market structure. And for us, ban on inducements would be the right approach, so the structural approach. Because one thing is to be aware that maybe not everybody is trustworthy or not everybody is giving advice in your best interest. But it's one thing to be aware of that, and another thing really to design the whole system of financial law and regulation around the concept that too many or majority of advisors are not advising consumers in their best interest. And I think really focusing on regulating this type of behavior is not the right approach. And we are also disappointed that the evidence from the Netherlands, the evidence from the UK, the findings from the study from 2018 were clearly said that the cost of advice and the cost of retail investment products was much lower for the consumers in those two countries, was not convincing enough to go for inducements. But we also have a lot of empathy for Commission because, as Sean said, they were considering this seriously, and due to the pushback, lobbying, and also pushback from some very prominent policymakers did not in the end allow for introducing the ban.
But from a market integration perspective, what would be your optimal solution? There is not only an issue of a ban, let's say there is an issue, let's say that we have an extremely fragmented market, which increases the cost of products.
Yes, so our many studies of Better Finance have pointed to the fact that the markets are very fragmented, that consumers are not investing cross-border, that even the rights of the shareholders are not respected cross-border. So in fact, CMU doesn't exist, and we actually really think that two main elements for that would address this problem directly. One would be actually the ban, so like really structural answer, and the second one would be really coherent rules across different categories of products. And this, I don't know, maybe we can discuss it a bit later, is also not properly addressed by the proposal.
Okay, we have two big also European providers around the table which can give their insights on this proposal, but also on the broader question, let's say, how to create a more attractive market towards consumers for investment products. And let's say this gap which we have, not only an advice gap, but I would say an investment or a long-term savings gap which we have in Europe. So I turn to Sylvain from Allianz. Sylvain, thank you for joining us this morning.
So maybe I'll try to answer some of the questions that were raised by other panelists, and then we will dive into the Q&A. As an insurance company and as a participant in the financial market, we really believe in transparency, and we believe that advice is needed. And when John was questioning what is advice, it's helping the customer, clarifying his needs, and turning its concern into a solution. And believe me, when you see a real retail investor coming to your financial advisor or coming to your shop as a tied agent, you see somebody that has no idea what are his concern. He has cash available, he wants to invest, but is it better to invest in the financial market? Should he go for a personal European pension plan? Is he worried about his pension? Is he worried about buying his new car in a couple of years? And the role of the financial advisor is first to clarify his need and then to find the proper solution. And we believe that there should be a bias-free advice and that this advice should be given in the best interest of the client. But when you go to your dentist, you have no idea, you just have something hurting, as you said, you have no idea what's the problem, and when your dentist tells you you need to have the teeth removed, you trust him. And why do you trust him? First, because you chose them. Second, because it's a highly regulated profession that he went to university for 7 or 9 years to get allowed to perform this type of surgery. And you know that if he's lying to you somehow, he can be sued, and that sooner or later he will be banned from being a dentist. And we believe the situation is not very different when you look at financial advisors. They are highly regulated. They are chosen based on trust, recommendation, and trust is their primary asset, and that's the way they can advise customers. And if there are some people giving bad advice because they want to maximize their own short-term compensation, we should separate the wheat from the chaff, and we should certainly make sure they cannot operate as an advisor, and that's what most of the regulators are doing in Europe. The second issue is that it's great to have low-cost product. I love an ETF, I love clean shares, and we'll discuss that. But sometimes people want guarantees. I'm not talking of, very, rebalancing techniques within some ETF or mutual funds. I'm talking about hardcore guarantees provided by a balance sheet and with a financial institution that commits to deliver a minimum return or a minimum payoff after a certain amount of time. And when you look at 2022, all the markets, look at the bond market, the equity market, most of them were in free fall, and the only safe haven for investors were the traditional fund in the life insurance policies. I'm not saying it's the best fit for everyone. I'm not saying it's the best return. I'm just saying that some people are loss averse and are ready to reduce their returns, because if that's what they're looking for, just a safe haven with a secure return, that's something we can provide as an insurance company. Once again, it's not the best option for everyone. Once again, it's not something that should be automatically recommended. I'm just saying that it meets the demand or the requirements of more than 60% of the people that we see as a customer. And in France, for example, it's extremely popular as part of the investment, and it's something that comes at a price. There's Solvency II, there's a lot of regulations and so on, and these type of guarantees comes at a price, but people are willing to pay for this safety that takes place at every moment. Speaking for the defense of the Commission, I must say that a lot of progress were made during with the PRIIPs regulation, and that as an industry, we believe that PRIIPs and MiFID are converging, and that's a good thing, and that's providing more clarity for our customers. And as an industry, I think we'll continue to improve, to have simpler product and to have cost-efficient product, and that this single fact sheet is a significant way to improve the visibility of the cost. And so, once again, we're not asking for a status quo, and convergence is a great thing. My last comment is that, to get back to what Barbara was saying, sometimes we take brave action, and talking for Allianz France, what we did is that we decided that all our products will now be underwritten with an independent association that is protecting the investors. Some of those, nearly all of those associations that are regulated by law are members of Better Finance, and they are clearly doing their job, controlling what the financial institution such as Allianz is doing. And this system is so effective that it's even mandatory for pension product in France now to have this third-party association representing the best interests of the clients and controlling what the insurer is doing with the money and making sure that the product remains cost-effective. at the request of those associations in Alliance France, we have implemented a new contract with only clean share unit linked with ETFs, so with low cost product. And I must say that the local regulator, especially the French central bank, is taking very strong action against overloaded mutual funds, and that everything is going in the direction that is the one somehow pursued by the Commission. We will have more efficient advice and more efficient financial product, still allowing people to have access to advice and with a simple, bias-free commission structure that will improve, but that is effective in my view.
One additional question, Sylvain. Why don't we have more price competition in Europe? So why are these prices so different? Why are the cost on products so high? If you see that in the United States it has gone down enormously, but in Europe, it stays more or less flat.
It's a fair question. I think we have to look in our own backyard in Europe. The tax system is so complex, and all of the financial instruments we're talking of are somehow regulated by specific tax laws. If you look at the insurance tax mechanism in France, if you look at the same tax benefit in Germany or Italy, you need to navigate to find the best interest of the customer, and the best interest of the customer is often not to buy cheap mutual funds on a brokerage account, because you can be hammered by the tax system. So you need an advice also to navigate through the tax system. And that's one answer. The second answer is that people are afraid of making bad decisions. And there's a willingness to pay. So I don't believe that people are paying without being aware that they're paying. There's a willingness to pay to have advice, because people are terrified about crossing making the wrong choice when they have 20 funds to choose from. And so they want to be helped, and they want to make sure that they're taking the right decision for something that will be part of their asset for the next 20 years. So there's a willingness to pay, and that's the right of the customer to pay for the best advisor if he wants to.
Elisabeth, I turn to you on a market which is also European. We forget a bit about it these days now, let's say, but which also had a ban on inducements, and which was fairly cost efficient at some stage. Elisabeth, how you look at this debate now from representing a large British asset manager?
Maybe I talk about the UK experience a little bit later. Thank you, Karel. But I would just start off by saying where I fully agree with you, Sean, is that the status quo is not satisfactory when it comes to the share of retail participation in capital markets investments. So there we really share an objective to increase that. Overall, I would say your remark on the industry saying that we've done excellent advice over the last years. I think where we also can agree is that the hurdle in Europe for getting advice is extremely low compared to other jurisdictions. And despite that, people are not willing to invest. So the root of the problem, in our view, must lie somewhere else than in the advice. Well, you can always improve, but I think it's not the main issue here. Going back to the title of the panel, what is good advice? And I think here, just following up what you've said, good advice is a process. It's a process that consists of financial planning, a risk assessment, asset allocation. Then you look at the product range, the categories of products that would fit, and last but not least, but at the very end, you choose the individual product. And where we find the package proposed by the Commission a little bit underwhelming, if I may say so, is that it seems to focus on this very last item, the individual product choice, and not on all the other steps in the process, which need to be emphasized. And first of all, to increase the willingness to actually seek advice, because that's the ultimate element here. So we're not sure how the retail investment strategy really achieves the ultimate goal of increasing retail participation. It seems to be a conglomerate of specific amendments to increase investor protection. But it's not, again, it's not looking at a narrative which shows the benefits of investment, but is focusing again on the narrative which is very much investment is costly, investment is risky. And I think that's the wrong message to give to people in order to induce them to invest more in capital markets. There are two main building blocks which are of concern to us in particular. One is the value assessment, which concentrates very much on quantitative criteria. And there we see the risk that this will become a tick-the-box exercise. The benchmarking, in our view, will certainly lead to herding around the mean. There is no incentive to go below the benchmark, and for any innovation, that will be a huge hurdle. So we're focusing again on cheap. Now, altogether, that gives us the conclusion, or brings us to the conclusion that we're risking here to create a system where products are designed to fit fees, but not the investment objective of an individual. And the second concern is that we seem to replace advice, which is perceived by some as biased, or with another bias. And the other bias is cost. Cheapest product is the best product. And I think that's a very risky route to go down. So what do we need in our view instead? I think we need to really look at how we can support individuals to seek advice, to seek investments. We need to better understand how distribution works in Europe. I think we've raised this question at the CMU high-level forum 3 years ago, and we haven't seen more research on this, more analysis. We need to include banks in the discussion in particular, because they should know why people are not willing to move money from their savings accounts to investments. We need to include the employers in the discussion. We need to talk about auto-enrollment. We need to talk about tax. Tax is completely excluded. I understand this is a difficult topic in the EU given the competences, but it's the elephant in the room at the end of the day. We need to look at financial planning in a holistic way. We need to look at technology, and there I'm very much looking forward to your proposal on open finance. And last but not least, we need to change the narrative. If we keep on telling people this is costly, this is risky, why should they go for investments in capital markets? I think we need to have a conversation which shows them, shows evidence that it is much better to put your money into capital market investments than in cash. And a colleague of mine has just recently published an analysis here, and he looked at a period between 1926 to 2022, and he looked at different time frames of investments, so from 1 month to 20 years. In all of the cases, stock market investment was beating cash when it was about, can you beat inflation? And that's the ultimate question here. Can we beat inflation with how we invest our money? And if you look at all those periods, there's a 60 to 40 probability that cash will beat inflation over the different time frames. Doesn't look too bad. But again, in all of the cases, the likelihood of stock market investments to beat inflation was higher, and it reached 100% when you looked at an investment for 20 years. That's the story we need to tell people.
Thanks, Elisabeth. Very clear points. Probably I can turn back, let's say, to where we started, probably with John and Alexandra. Do you have a kind of response, certainly from John, on this issue? Let's say there is too much focus on cost, too much focus on not kind of having a clear narrative, not sufficiently helping people to go to the markets and to make this positive assessment rather than to have this rather kind of negative assessment which some see, let's say, in this proposal.
Thanks, Carol, and thanks to everybody who made comments, both positive and negative. I mean, just to pick up on this last point, as I said at the beginning, the retail investment strategy is part of a plan. So we are working on auto-enrollment, we are working on tax, we are working on insolvency, which you didn't mention, which seems to always be top of the list for everybody. We are working on technology, but we are also working on the retail side. So it is part of a bigger package. And you ask me to change the narrative and to stop telling the retail investor that things are expensive. They're telling us it's expensive. I'm not telling them it's expensive. We have done studies which show they think it's expensive. They think they get bad choice. So the narrative is not ours. The Commission does not have some obsession with cheap investment. The retail investor has an obsession with value for money. That's all. So this is not a narrative we're setting. We did studies, we did consultations, we have had organizations tell us this is a retail narrative, not our narrative. So we're responding to that narrative, we're not creating it. We, of course, do like to sell a positive message. We're trying to sell the positive message. But as people who know me again over the ancient time I've been here, when you come to my office, I tell you, you don't like my solution, that's fine, but do not deny the problem. And the problem is that there's a prima facie conflict of interest in a world where an advisor is paid to give advice by the manufacturer of a product. That's all. It's not the only problem. It's not the only solution to the capital market, but it is one of the problems, and we have to address it and not deny it. So, of course, we can talk about changing narratives, but you can't deny the other narrative which is coming to us is that the retail investor, apparently, based on surveys, does not feel well served. Now, another point I wanted to make is about where we confuse quality of product and quality of advice. There are issues on both sides, but don't confuse them. I mean, it may well be that a product is a very good product for somebody, but you have to be sure it's the right person to get it. So that's where the quality of advice comes. And in our strategy, we kind of cover both. We want to make sure that there's value for money in the product. And the benchmark is not some kind of price regulation. The benchmark is a comparison tool. You can charge what you like for your product, but you have to explain to your investor why. And if you can do that, and by the sounds of it, you're all able to do that, you should still be able to sell whatever product you like. You'll just have to explain to that investor why your product, which is X% more expensive, is worth the money. That's all. So this has been put forward as a form of price regulation. The benchmark is not a price regulation. The benchmark is a comparison tool. It enhances competition. If you are as confident as you all seem to be in the message you can send to your investor, then you should have no problem with the benchmark. It just allows you, it helps you, in fact, to explain the better quality of your product vis-a-vis the standard product in the market. I mean, on the other hand, I don't want to pretend this is a simple solution. I don't know whether just banning inducements like prohibiting crypto is the way to go here. We have to allow for a slightly more complex situation. But on the same token, I mean, I think we have to accept the fact that we have a system that exists today which is commission-based advice. And we're not attracting retail investors into the market. And that may be because of culture. But I tell this story always. I'm Irish, and when I left Ireland in the 1980s, I was told Irish people were not business people. We had a culture of singing songs and writing poems and, very melancholy people. I came back in the 90s, and they were the Celtic tiger. So this is about incentives. People will come to the market if you give them the right incentives. And those incentives are not, as somebody has mentioned, to find, as I found myself recently, that one of the returns on my funds, and I've never looked before, was 50% taken in fees, which was presumably for some advice that I had never received at the beginning. So I am not suggesting that the ban is an easy solution, but please do not suggest back to us that there's no problem. There is a problem. And don't I just suggest that the problem is somehow wider. I know the problem is wider. I have been 30 years working on the wider problem. But there's a problem here too. And if we're serious about addressing the demand side of the market, we have to address this problem. Now, maybe the solution is not a ban, but the solution is not the status quo either. So together, we have to work to find what is the best solution. And maybe we can find that solution before we have a ban, rather than find the problem after we have it. But we simply can't deny the problem is there. Thanks.
Thank you. Yeah, Alexandra wants to add something on.
Yes, I wanted to add something. I very much agree with many things that Sean said right now. I wanted also just to underline that, of course, being a financial consumer, individual investors, is a full-time job. So we really believe that investors should be able to rely on really good independent advice. We think maybe the first step should be really also changing and fixing the semantics and refer to the biased advice or conflicted advice for the clarity also for the investors and for individual consumers. And I also agree very much with the fact that the information to consumers should not be underlying just the cost and riskiness of investment. And I don't think that Better Finance has ever been doing this. We have been looking at the Capital Markets Union really holistically, both on indirect and direct investors. We have many studies that confirm how difficult it is to be also direct investors nowadays in the EU. But I think that saying that the cost of the retail investment product is really not the main thing, or that we should focus on the cheapest products only, is also not the right narrative, because actually what we found a couple of years ago when we were doing a study on over 2,000 of UCITS and IEFs was the fact that the more you were paying for the active management of the funds, the more likely you were to get a really bad performance. So basically the finding of the study was the more you pay, the less likely you're going to get something good out of it. So I think we also need to remember it, because the erosion of trust in the EU is not coming out of anything. It's coming from many mis-selling scandals, it's coming from not getting good advice from the advisors, and also the narrative right now that investors are not really willing to pay for advice. This may be true for some of the investors, but nowadays they are paying, and they are not paying for advice, but for a sales pitch. So I find it particularly unfair, and many of them are believing that they are paying for advice.
Probably a point to go back to Barbara first on this, because the Dutch have gone this entire experience. Are Dutch consumers no more satisfied by the products they get, and is there more trust?
There was no trust at all after the scandal that we had. So this was a really real problem. And I think I like to stipulate that also implied that industry back in the days was on board on the change that we had in the Netherlands. So that is, I think it's a big difference than when we have now in Europe. So they really felt the need that something needed to be done. And if I may, I tell a short story, because I understood we have the comparison with doctors and financial advisors, and kids in lower primary schools, they don't want to become a financial advisor, they maybe want to become a doctor. So, but the scandals are everywhere. So in the Netherlands, I think it's a couple of months ago, there was a hospital with the heart surgery department where the surgeons actually got paid for a specific device, and over the years they have done more surgeries than actually was needed. Of course, when it came out to the public, everybody was very angry and upset with these kind of things. But just to face it, these kind of things happen on maybe a lesser scale in financial services every day. So if you tell about this, like this heart surgery things, it becomes more alive and everybody has a feeling about it. But if it's a couple of investors who really lost a significant amount of money, it is a problem. And I agree with your story that you said we should not focus on, Elisabeth, on risks and costs only. As a regulator, we like to point out to the risks as well. I think it's also good to give a responsible story that investment doesn't go without risk. There's always a chance of losing money. It's not a reason not to do it. And I think we had a huge debate in-house at the AFM. Last year we published a paper also on there's still room for people to enter capital markets and not for saving. This is also a little bit of bravery from a regulator to actually demonstrate that there's still room for improvement there. So I think, yeah, I think it's sure that a ban on inducements is not the only thing that needs to be done to ensure trust in the financial system. Also, when we had it in the Netherlands, so I think we were the first countries who have product oversight and governance requirements, which landed then also in MiFID II. I remember the discussions back then. The inducements discussions didn't came that far. They became a lot farther this time. But I think that you need to look at it as a whole perspective. And if the problem is indeed we want to attract more people to capital markets or invest for later, it starts with primary schools. It starts somewhere else. That doesn't mean that in the system now we don't have issues to solve. And I already mentioned it before. I think I wish well for all European consumers. And no, I can repeat myself, but that's better to have paid advice instead of no advice.
Okay. Robin wanted to share a point?
Yes, absolutely. Wanted to make a couple of points. First of all, on this point of, low cost not being the right solution necessarily, and also the role of the advisor in managing consumers' appetite for risk. So, again, Better Finance, a lot of academic institutions have researched this, and there is just strong empirical evidence that low cost is in fact the right answer, because the hurdle rate is just so high for investors to clear when they're investing in high cost products. And with active management, a lot, does work. We offer active funds, but we offer low cost. And so there's just a lot of evidence that costs do matter. And importantly, as consumers, they're one of the few things we can control, because we can't necessarily control the risk of equity markets once we're into those markets, or fixed income markets, as you mentioned, which were a factor last year. So low cost does matter. I just wanted to share maybe an insight from a couple of markets we work in quite extensively, the UK and Australia, where commissions have been banned, and there's a really established fee-based financial advice industry. So moving to this fee-based model, which is extensive in the US as well, despite a ban on commissions, means the role of the financial advisor has to change. So they move from salesperson to financial planner and financial coach especially. And that's an incredibly valuable role. We do research around this. We think it adds up to many % a year that they can really help investors with. And that's because they do this job of setting goals, of getting people into the right product structures, and then coaching them to really see things through, work through periods of difficult markets like we saw last year, stay focused on their long-term goals. As I mentioned earlier, often, majority of the times, retirement, but that's not the sole goal. So when we look at markets like the UK, when we entered the market in the UK around the time of the commissions ban, future financial advice, we saw very little allocation to low-cost products. Maybe 7% of retail market portfolios were in index funds, which is probably the purest form of low-cost investing. Today, that would be around about 30% of retail portfolios, because what's happened in all of the costs that go to an investor, paying your financial advisor, paying your fund manager, paying for your assets to be custodied, everything really has had to reduce in price. It's in fact the financial advisor that's continued to keep their fee because they demonstrate real value, setting a financial plan, being a financial coach. So that's an important evolution. The way that we have supported that market, and similarly with our Australian business, is we have a range of diversified products. They invest in fixed income and equities. They're passive index tracking products, and they are, 0.22%, very low cost, 29,000 underlying securities, very diversified. So financial advisors in the UK have really picked up those products. They're probably the purest form of advice, and that's already embedded within the product, because you get asset allocation, you get all of your securities investment, and though that product range has grown enormously in the UK, enormously in Australia, we've launched them as UCITS ETFs in Europe. Again, people can self-select those. So this is what happens. The investment fee is compressed. The advisor fee is where you have to deliver a service and you have to move from being a salesperson to being a financial coach, and you can have a big impact. And businesses in the US are transforming themselves in that way because that's a really great business and it's a subscription-based model, so that makes for a good business. One further point is we mustn't also label advice as one hat fits all, because investor needs are very, very different, sometimes very simple, where, I know in the UK we can offer more simple guidance solutions if you're willing to share your time horizons or your risk appetite. We can, help you construct the right portfolio. That's important. Not everyone needs really extensive, comprehensive planning advice, and many people, especially young people, when they first start investing, getting into the workforce, thinking long-term about their goals, it can be quite simple, and if they are embedded with high costs early on, that's just going to take away so much over a 10, 20, 30-year time horizon. So thinking about the range of solutions and the role of digital and technology in helping get those more simple solutions in place is also going to be important in reducing costs.
Very good, Robin. So probably which leads to one of the final questions to Elisabeth and to Sylvain, that the advice as constructed today is too monolithic. So our advice, which we have in Europe, is not sufficiently adapted to the consumers. And basically we say, look, they need advice, but if you look at the advice which we give, or say which is comprised in the price mostly and for most European products, is basically a very high cost for a poor value. Sylvain?
I think we should get back to what Elisabeth was saying. Advice is a process. And if you look at the European regulation, it's a long and painful process. It's nearly impossible to underwrite a life insurance policy in less than 2 hours. And I've done the exercise in 3 different countries. So you have to go through a risk assessment, you have to go through your risk tolerance, you have to assess the horizon of your investment. It takes a lot of time, and it takes some very skilled people to discuss and help you answer the question. So when you were asking, why is advice so expensive? I mean, first answer is you need very smart and qualified people. Second answer is it takes some time. And that's something we can also address as part of this regulation. We want people to have access to good advice, but maybe at least we can help the people have access to simple financial instruments in a leaner way.
Why should that be for 30 years then? Why should I pay for 30 years for advice? Meaning, because for the one time I get advice, I pay 30 years.
No, because...
And I'm linked to a tax, whatever, deductible product, and I cannot get out of it.
And if I may answer for the French market, which I am most knowledgeable of, the first one is your advisor has a duty to contact you at least once a year to make sure that the asset allocation is still consistent with your risk profile. And if there's any update in your situation, it is required by law to change your asset allocation and to make sure it gets back to your risk tolerance. So it's not a one-time advice for 30 years. It's a one time per year, and it's actually part of the fiduciary duty of the financial advisor to receive some commission. I have a second remark regarding the benchmark. I mean, happy to continue on the advice, but
quickly, because we need to.
Yes, very quickly. I think benchmark is great, but it can be extremely misleading. I mean, if you compare only cost and even cost and risk, how can you compare a real estate investment trust and some also 5 year time horizon diversified bond product? I mean, you may find the same volatility. And one is much more expensive to manage, and still, in the end, the total return that you're paying to your customer may be similar or better, or some customer may prefer one over the other. So focusing the comparison on cost and risk can lead to very misleading output or outcome, and I think that's where there's some anxiety, making sure that if there's a benchmark, and there's likely to be a benchmark, then how can we make sure it's not misleading and that we're comparing apple with apple, and that we're not goading the client in the product that is not the best fit for him.
ambition for a benchmark is just to focus towards simple products, as Robin was saying, as Alexander was saying, Elizabeth? Is this not, a good ambition of the Commission, let's say, that we focus insufficiently today, let's say, towards standard products, and in this sense, try to come to a more open, European-wide integrated capital market for investment products?
I don't think anyone can argue against more integrated markets. Just to respond to some of the remarks, Sean, I get your point, and I don't want to appear that we don't want to change anything. There is always room for improvement. But where I'm a little bit hesitant is when you say that the main factor for individuals not to invest is the cost factor, or that it is a very important issue for them. I'm wondering, why do they think it's costly? So what is the reason? I think in many instances it is that there is a perception that financial advice or going to your bank, and that's the main route, let's face it, in Europe or in the EU, they think that should come for free. Yeah? They don't see the added value, maybe. They don't see that, the whole process behind it. I've worked for a bank at some point, and the numbers I heard then, what it costs for regulatory purposes to set up a bank account, I'm not talking investment here, is enormous. So that money has to be earned somewhere, but it's not clear to an individual that comes and seeks those financial services. So I think that's also a matter here that we need to work on. When you talk again about costs, the UK experience is that doing a value assessment and doing the RDR with an inducement ban, overall, it didn't reduce the costs. That's the issue here. The value chain costs, yes, they went down, but the advice costs increased. So overall, the situation, the cost situation didn't change. So that's why I'm just putting a question mark to some of the proposals. Just allow me one last remark on the mentioning of ETFs and index funds. I myself have partly invested in an ETF. I'm admitting it, don't tell my employer. But what I'm trying to say is that you need to give the choice to the individual. And in some instances, an ETF and an index fund may be the good choice. In other instances, it might be something else. I think we need to really make sure that we're not driving everybody into one particular area and the pendulum swings there when perceivedly it has been on the other extreme. So, and there's a wider societal question, a wider economic questions. If we were all to invest in just an index fund, and again, I see the merits, yeah. If we were all, we're not going to we're not going to find the solution to the economic challenges that we have in the EU or globally, which is the sustainability and which is also about venture capital, etc. We cannot solve that with the cheap.
We can certainly invest a bit more in ETFs in Europe. Well. We are certainly not at the 30% yet, and I think on the issue of advice, I think the Dutch have got a very good experience. Let's say the cost of advice has gone down, let's say, with the ban on advice in the Netherlands. Alexandra, a final point, or I don't know whether John wants to say something at the end, because we have to close.
Yes, just
Alexandra,
remark.
very quick.
Yes, I very much agree with Elizabeth that actually we need to give investors the choice. The problem is that in the current system, they are not being given the choice, because when they go to the advisor nowadays, they are never offered ETF. They always offered some, normally, I mean, this is also the findings from the Commission study, that they are offered packaged complex products, and ETFs, if they ever are offered, it's in the Netherlands and in the UK, as the study confirmed, or the robo-advisors and platforms.
I was offered it in Austria, so, and I could buy it, so I'm the living proof. There are exemptions.
Exceptions.
And I can get you a contract in France if you really need one.
Okay, thank you. I mean, with this, let's say we'll conclude this panel. We have started to dig deep already in the Commission proposal, which is only 1 month old or so, yes. So we have started to do this. Probably we had to expand a bit more into broader issues than only the Commission proposal, but I think it's on everybody's mind. And let's say by this, I think we have started this conference very well, also after Eero's start and let's say, the introduction of this speech. So there's a lot of things to discuss, so thanks to all in the panel, let's say, for a very interesting start and for a deep dive, let's say, in what is being, on everybody's minds at the moment, as I said. So there is a coffee break now, and then we reconvene in about 15 minutes. So thanks a lot to the whole panel.
Please have a seat. We have to resume now. Ça marche. So, we are going to resume. We are a few minutes late, and it is my great pleasure to invite, I would almost say, a regular at Better Finance events, because when we ask him, he's always present. But that was easy when he was only, quote, chair of the Belgian regulator. Now he is still the chair of the Belgian regulator, but it is also the chair of IOSCO, the worldwide organization of securities control organization. So let me welcome Jean-Paul Servais for a keynote speech.
Thank you, Guillaume, for your kind words I don't deserve. So good morning, ladies and gentlemen, and I'm used, like many other speakers, to start my speech with it's a pleasure to be back somewhere. This time I'm back in Brussels, which is quite obvious because I'm a Brussels-based supervisor stressed by Guillaume, but even it's still a surprise for me because most of the time I have the pleasure to be abroad. Last week I was in Bangkok for a very important historical annual meeting of IOSCO. So some people would say IOSCO, it's about wholesale, other aspects. But frankly speaking, I think that I may say that times are changing. That's the reason, dear Guillaume, I'm so pleased to be one of the speakers in your program, especially with the last sentence, towards a CMU that works for people. That's exactly, I would say, my involvement for many years. I am the first one to say that the starting point of the mission of the Belgian supervisor, it's about John and Mary in the street, I would say. And that's also what we are doing more and more at IOSCO level. And that's the reason why it's a real pleasure and a privilege to stand before you to speak about a topic that lies close to the heart of many present here today. And congratulations, because the audience is very impressive. And I would like to give you some comments about what we are doing about IOSCO. A mistake would be to think we are in Brussels, so it means EU regulation, so it means no interaction between IOSCO and EU. At the contrary, because from a historical point of view, I'm not sure that so many of you know that the first, I would say, the underlying philosophy of many aspects of the regulation, in fact, are coming from IOSCO initiative. The first, I would say, aspect of the regulation about asset management are, in fact, issued many years ago by IOSCO. The same for benchmark, the same for rating agency, the same for IFMD. So it means that by definition, there is a positive interaction in both directions. I personally belong to the school of people saying, if we have a global agenda, so it means high-level principle, then it can be fine-tuned, translated with more granular aspect, and if needed, binding regulation. In Europe, why not? Because it has been tested before at international level, before becoming something which can be also useful at EU level for the sake of the protection of, I would say, market participants. And that's the reason when I think that IOSCO is the place to be. I'm not sure that everybody knows in this room that IOSCO, it means a rather unique global membership organization. And why do I say it's a little bit arrogant, but I think it's not far from the reality when I say that IOSCO means that all members at national level are involved in various capacity in the supervision of 95% of the global financial sector all around the world. It means 130 jurisdictions. It means also that the majority of our members are representative of growth and emerging countries. It means that scalability. It means that take into account the specificities of different markets. It's part of our DNA. And that's the reason why also I think that IOSCO is so important for John and Mary in the street. Some people who are forced to listen to me from time to time know that I also like to speak about John and Mary in the street, which is a fascinating starting point when we speak about, I would say, sustainable finance, because in fact, all the story, the nice story, the positive forward-looking story about sustainable finance is nothing in link with the European Commission, with IOSCO, with the G20, with the FSP. It's linked with you, if you are a private investor, John and Mary in the street. They would like to invest in product in listed companies which are in line with the AZ expectation. They are waiting for us. They won't wait for a while. So there is a sense of urgency, but that's a fantastic journey because the objective is to deliver on time a global toolkit about sustainable finance. That was my first comment as new elected chair last year in Marrakesh at the end of October last year, and I'm sure that we will do it, let us be clear. And the objective is to be ready with a comprehensive toolkit for the filing of the 2024 annual financial statement. But due to the fact that the objective of today's meeting is not to speak about sustainable finance, I would like to give you some comments about 3 other important priorities which are important for me personally, but also for all the IOSCO village and I would say ecosystem, which are important in order to safeguard the interest of retail investors, which is a core objective for IOSCO. And you will see in the new logo, in the new branding of IOSCO to be released in some days, there are 3 dots, IOSCO on the I. I would say it means consumer protection, fair and transparent market, and financial stability. We start with consumer protection. That's very important for me personally. That's the reason why I would like also to speak about 3 important aspects, because whenever we speak about John and Mary in the street, about consumer protection, it means also trust in capital market. That's also very important. And therefore, I think it's important that I would like the possibility to have this kind of dialogue with you in order to give you some comments about our last report on retail market conduct, our recommendation on a crypto asset, and last but not least, dear Guillaume, is it a surprise? Financial education, of course. It's part of my life for many years. First of all, report on retail market conduct. We publish, as you know, on the 30th of March this year, our final report on retail market conduct. And this report not only highlights a wide range of current retail trends, but it also identifies sources of potential retail investor harm in an increasingly online environment. Let us be clear. Many people now think it's quite normal that IOSCO publish something. It was not the case, let us be clear. There was some pushback many years ago. Are we sure that we have sufficient capacity to deal with retail investor protection, especially at cross-border level? It was before the new world. It was before that. A training app is not only important for your private life, for booking point coin, but also for retail. It means the capacity to have a bridge between very sophisticated manager and very unsophisticated, without experienced investor. So it means a new world. And that's the reason why we decided to launch a work stream with a strong link with technological development, because technological development are by definition permanently changing the way in which retail consumers interact with financial services and products. And we live in a world when social media is now a major, in some cases, the most important source of information for retail investors. I presume that you know the story of many teenagers, many children, telling you, but do you think that people will still read books in the future? something quite amazing for us. So it means that the only channel of communication for many, even people graduating university, that's it. Not a big screen, a small screen, and that's a very important revolution for a financial supervisor. And that's the reason why it's clear that the increasing digitalization of financial services and the ever greater use of online distribution method also provide fraudsters with easier and cheaper way of spreading their false communication to a wider target audience. And more, digital promotion, online marketing are used to facilitate fraudulent activities. Crypto asset scams and greenwashing practices are two important examples of misconduct arising for such global trends and technological development. And what's the answer of IOSCO to respond to these challenges? We are convinced that regulators need to address retail investor harm at its roots. For instance, regulators need to employ and master the same technological tools as those used by market actors. I can tell you it's a real evolution. As CEO of the Belgian supervisor, you need to teach to the teacher how they have to react, to use the same channels. Frankly speaking, I can tell you it's a real challenge about human resources. And this is absolutely instrumental in order to more effectively track and intervene in case of fraudulent online marketing channels. In Belgium, we decide to set up a new services fully dedicated to artificial intelligence. We decide to engage a lot of people with PhD, not a tradition in Belgium, as you know, and it works. We have the capacity, even in our ex-post supervision, to track the day self many aspects of marketing which is not compliant with the EU guidelines. But let us be clear, persistent challenges, such as the one we face today, require also a coordinated regulatory response to global risk, to global challenges, a global reaction from the community of financial supervisors. And this is why the importance of reinforcing cooperation on enforcement of cross-border misconduct cannot be understated. And that's the added value of IOSCO. Why? Because combating a financial force on a global scale requires global cooperation. Our report, therefore, also includes a toolkit. We are a membership organization, so it means that we need to be helpful. It's about also capacity building. And that's what I've been able to do by releasing this report, with a toolkit which outlines several adaptable measures for regulators to consider when dealing with retail market conduct issues. With 5 key messages, for instance, heightening regulators' digital presence, an online strategy to proactively address retail investor harm, owning approaches to better identify and mitigate misconduct, third aspect, enhancing cross-border and domestic supervision, fourth aspect, implementing new regulatory approaches against retail misconduct, and last but not least, addressing retail investor harms that stem from crypto assets. Second main initiative, crypto assets. Yes, we also decided to be very active about crypto assets, but on time. We launched a new task force at board level before Terra Luna, before the crypto winter, and of course before the FTX collapse. Of course, we were able to take into account new market development, but we start this task force before the crypto winter. And after very intensive months of discussion, challenge, we have been able to publish 1 month ago, in the premises of the FCA, our consultation report of a crypto asset. I have to tell you, I was very surprised by the press coverage. I think that's the most important press coverage. I had the surprise to be quoted in the Daily Mail, which was not an objective for me as Belgium supervisor. The quote wasn't bad, even good, I would say. But the press coverage was absolutely unbelievable. So it means that what we are doing is maybe matched with the expectation of many people. And I think also that one of the reasons why there was such an historical press coverage is that many people were surprised that we were able to deliver on time and even faster than expected a consultation report about crypto assets. So it means sense of urgency, speed is one of the priorities in my, I would say, during my chairmanship, speak about crypto asset, sustainable finance, and BFI. And of course, underlying aspect, it's about inclusiveness. And the reason why the speed, which doesn't mean that we had problems by managing decision-making process, of course, but speed's important because IOSCO thinks that in order to mitigate the risk that crypto asset can pose in terms of retail investor harm, that's the reason why we had to launch this consultation on detailed recommendation to jurisdictions worldwide on how to regulate crypto asset and adequately address the risk exposed. For me personally, it's important because I think that I may understand that some of you have some children, some of them are kids, teenager, or adult. What's the first experience for all this new generation of investors? Sorry to tell you, not about UCITS. Maybe they are not fascinated by kids, other kids. PREPS, Solvency II, not sure. Crypto, of course. And that's a real challenge because, of course, they are facing many, many risks that we know. And if they have bad experience with that, they will disappear from their connection with the financial world. That's the reason why it was so important for me and for my colleagues and friends of the IOSCO to be able to be on time. And that's what we have been able to do. And what we are, I would say, proposing is in fact a major initiative designed to improve global standards for the regulation of crypto assets. Why do I dare say that, okay? Many chairmen are used to say that, okay, it's a new game changer, what we've been able to do. But frankly speaking, I think that's the case with this recommendation because we set out how clients should be protected and how crypto trading should meet the standards that apply in public markets. And what we are proposing is a real turning point for crypto assets. And the timing could not be better because the time has come to put an end to the risk of regulatory arbitrage surrounding crypto activities. And there is a general consensus on this at global level. Was it the case before? No. Was it the case at the time that sandbox were in the hype? No. But now people realize that it's time to take action at international level because the risk is also about cross-border business. We are not the only one, I would say, to say that. As you know, the Japanese presidency did an excellent job by releasing a G7 statement stressing the importance, the added value of the work published by the IOSCO, and the FSB will elaborate on some aspect relating to financial TDSM. But let us be clear, the publication of IOSCO is a thing, I'm sure, I'm convinced when I'm saying that this is the first time such a globally consistent framework is being proposed for crypto assets in order to protect investors. And IOSCO proposal is thus a real game changer. Recommendations stem from a very straightforward principle: same activity, same risk, same regulatory outcome, and propose, amongst other things, to address issues such as conflict of interest and the safe custody of client money and assets. Crypto asset providers need to address unacceptable conflict of interest and take far more seriously the right of clients to have their monies and assets carefully safeguarded and accounted for. Let us be clear. I am sure, because I see many people, I have the pleasure to meet. Some of you are specialists of trading venue. Some of them are usual victims of all kinds of regulation about asset management. You will say, I'm losing my time. What Servais is explaining is something I'm required to do for 30 years. And you are right to some extent. Is it a revolution to speak you need to avoid conflict of interest? Is it a revolution to say that you need to avoid any aspect relating to, in order to avoid problems about fencing? Is it a real revolution to speak about custody of the assets of your client? Of course not. But it was not done, let us be clear, at the start of new business model related to crypto assets. And that's the reason why it's so important to dare say we need to apply this rule to this new business model. And that's the reason why it's a real game changer. Just for information, July means less activities with the Commission, So it means that you have plenty of time in order to send your comments to the consultation people deadline 31st of July. And we would appreciate to receive your comments. Last but not least, and I will close on time, dear Guillaume, empowerment of retail investors through financial education. I belong to the school of regulators who thinks that we need to have a balanced approach, to be tough when we have to be tough as supervisor, but also to be helpful for financial education. That's the reason why we start the Belgian FSMA already 14 years ago. I lobbied at political event in order to receive the capacity to be involved in financial education. After 14 years, we have a website which is visited more than 4 million every year. Of course, it's not the Belgian teams of the Red Devil. We are less popular, but 4 million for a public supervisor, it's a real fantastic success. The same for a financial education center. I recently launched an invitation to the person who will be the next keynote speaker, Commissioner McGuinness, to say, we are speaking most of the time about financial education. It's part of the new retail investors. Excellent news. If you want to see a very day-to-day implementation, please visit us. We are with Google Map, 400 meters far from the Berlaymont, and even less, starting from DG FISMA Spastrat, it's 200 meters. And WikiFinLab means the only one fully fledged, for free, interactive center for financial education. Target the teenager, you children, 16 to 18. When we start the discussion in order to launch, I only receive bad advice from so-called consultants saying me, Brussels is a too big city. Dutch-speaking, Karel, would refrain to go to Brussels. The same for French-speaking. We launched that during the COVID with the presence of Her Majesty, the Queen of Belgium. But I can tell you, 3 years after, we are fully booked all the year. When we opened the inscription, last weekend of August, in 2 hours, we are fully booked until the end of June next year. So it means that people think that we have an added value. It means that we are able to have a message which is not about knowledge. We are not explaining very difficult aspects about structure, but we are speaking about what it means financial education in the day-to-day life, how to manage your budget. And that's what we need to do. And that's the reason why I was also so pleased to explain you what it means financial education in order to close my comment, dear Guillaume, on time. That's the advantage of being chair at IOSCO. You have to give the floor to many people. Thanks. Do I receive an inducement for that? No.
No inducements from Better Finance. Thank you very much, Jean-Pierre, and we could not agree more. For example, when you say on crypto that same product, same market, same rules. So without any further ado, please, for the next panel, which should be quite exciting, if the panelists and the moderator, if you could come in. So this will be moderated by Rebecca Christie, and please welcome her and the panelists.
Thank you. Hello. See, it's good to vamp a little bit at the beginning of your panel. We are here to talk about retail access to market data and best execution issues. I'm very much looking forward to discussing these issues in a retail context because most of the events I've been to on these files have been about wholesale, about the industry and the infrastructure, and this is a chance to really talk about what these things do, what their eventual impact is. We have a great panel here. We will hear from each of them. We will talk amongst ourselves a bit, and then we will open the floor for questions. Conference organizers, if you could give me a signal when we're running down close to the end of our time, because I don't have a clear clock here, but otherwise we will try and see how we do. With that, our panel today, we have Niels Braab, Head of Group Regulatory Strategy and Chief Regulatory Officer from Deutsche Börse. Then we will have Henrik Hussmann from Nasdaq Helsinki and Nasdaq European Markets. Next speaker will be Ben Granger from the Flemish Federation of Investors. Then we will have Christian Hecker from Trade Republic over here, yes. And finishing up, Salvatore Gnoni from ESMA to give us a regulator's perspective. And with that, I will turn the floor over to our panelists. How many? Okay, we've all got mics, great.
I think now we're on. And of course, I would also hope for anyone to give us a sign on how we're doing time-wise, because otherwise we will have the challenging task of standing between you and your lunches. Starting right without any direct question into the panel discussion, I think from the outset we have two major issues to discuss today. One is really on market structure, or different avenues of trading, as I like to call it, for different types of investors. And the other big question will, of course, be evolving around market data, data availability, quality of data, and the famous consolidated tape. Before I jump into some of my main comments, I would like to thank Better Finance again wholeheartedly for organizing the event today. I think it's also very important for all of us here in the room because we all form part of the Brussels bubble to talk increasingly more about retail investors' interests, because it's really key and the heart of also broader picture, big ticket items like the Capital Markets Union, where I think we've seen for a long time a lot of heavyweight politicians and senior leaders calling for more endorsement of the CMU by citizens and retail investors. And that's also why I think having an ambitious retail strategy by the European Union is an extremely important element in all of this. However, I think when we come to discuss MiFID and MiFIR, there are of course also a couple of elements which need to sort of match that broader political vision, because clearly when it comes to, for example, transparency on equity markets, the clear conclusion is after the phase-in in 2018 that MiFID II has miserably failed. And I know many of you know me as being very outspoken and harsh on that perception, but the reality is that overarchingly lit trading volumes went down since the introduction of MiFID II, so that's exactly the opposite of what we aim to achieve. And a particular problem in that regard constitutes, of course, also the systematic internalizer regime, as we have heard many times over the last years in many of these discussions. I think from my perspective, there's really a need to understand what the implications are beyond sort of the societal perspective, where the hyper-fragmentation that we see on equity markets in the European Union, where we have more than 250 execution venues nowadays, leads to inefficient capital allocation and definitely less quality and less liquidity and depth with the main markets. Now, one could say, of course, competition is a good thing. I'm a competition lawyer myself by background, and I would always welcome competition as far as it's bringing down prices, spurring innovation, bringing better products. But clearly, there's also a limit to competition as far as competition on different regulatory terms is concerned, because we can all agree safely that that probably doesn't really constitute competition, but rather an unlevel playing field. And this is also what we continue to observe on market structure quite drastically. Systematic internalizer regime, for those of you who may be less acquainted to it, of course, has seen sort of the creation of more than 100 of such execution venues since 2018. Why is that a problem in itself? Because they are not pre-trade transparent, they are often not really post-trade transparent in light of many deferrals that they can use, and also there's a big lack of market data quality coming from alternative execution venues, which is a topic I think Rebecca will be touching also on again in the second part of this panel when we discuss market data and the consolidated tape. So concretely, my suggestion, and I know the MiFIR review is of course already in the trialogue phase, and it will be interesting to see where this plays out. But we continue to, of course, advocate for reinstating a fair level playing field to the extent that systematic internalizers are boxed into large and scale transactions. For those of you who may be a bit further away from some of the empirical realities, that means orders in the range of 100,000 euros or upwards. Why is that important to us? Because the latest empirical data, for example, that you can find through LiquidNet report, indicates very clearly that the average size of execution is only 11,000 euros in systematic internalizer. So that means the average order size there, or executed order, is actually partially smaller than we see on some of the regulated markets of the European Union. And that is, I think, in a nutshell, where I would stop, Rebecca, and happily hand back to you before I capture the panel with a German monologue, and then happily jump in at a later point when we discuss PFOF, market data, and other elements. Thank you.
Thank you, yes. Thank you for setting the stage. And now let's see, Henrik.
Yeah, thank you. Thank you to Better Finance for inviting me to this panel. I think the topic couldn't be more important, i.e. retail investors' access. It's so important for the price formation and SME financing. And certainly my place in the panel right after Niels, I mean, if I was lazier, I would basically conclude by saying that what he said and stop there. But maybe just to add something, first off, I mean, despite well, I guess we are here to solve issues, but still I dare say that at least looking at the Nordic markets where I'm coming from, the situation with retail investors' access to equities, it's never been better. And the conditions overall have never been as good as they are today. And now I'm referring to the costs of investing in equities. They've never been lower than they are today. Access to equities, I mean, just a couple of years ago, you couldn't have imagined having direct market access into equities as a retail investor. So you can invest directly at a very low cost point. Also then new products, well, new, but anyway, products like ETFs, I mean, the use of ETFs has increases constantly, and that of course is helping take down the cost of your savings, which by the way is the only known thing when investing. The only known thing is the cost you pay. So hence one cannot talk too much about the cost aspect of investing. Then also if you look at the access to research, which again is very important, still at least in the Nordic markets, even with the MiFID II introduced unbundling or bundling ban, if we call it that, paid for research has really increased a lot. i.e. issuers are paying for research, and that's actually helped a lot, especially with the SME companies, to continue having research coverage, which of course for the retail investors it's very important. Also financial literacy, which I think it's really at the core of retail investment, i.e. improving the knowledge base of our normal citizens related to their financial matters. Also there, despite still a lot to be done, but also there I would claim that it's never been as good as it is today in terms of the schooling system. At least they give you basics of handling your finances. Social media, even though it's also full of bad advice, but you also find a lot of good training material through social media if you just find the interest to look into it. So just wanted to start off with kind of a positive story in that despite many ways to improve the situation, I dare claim it's never been as good as it is right now. Thank you.
Thank you for that. As someone who grew up in the United States, where capital markets have a very different role, I'm blown away that it's novel to think of retail investors buying individual stocks. This is something that, on the one hand, we experience in our day-to-day lives. On the other hand, when you put it that way, it really shows what a big gap there is between what people think markets do and what they actually do on a daily basis. So we go now to Ben, talking about investors.
Well, I would like to thank you to be able here. I'm honored and a little bit intimidated to represent the individual investor, because this debate, I've heard so many things today that I have a problem structuring my head. What's in it for me? That's basically the question. This has been called the MiFID and MiFIR trialogues. I think we're up to an octologue by now, because there's so many different parties involved. We are not homo economicus. There is so much information. I think the retail investor really has a problem in figuring out what is to our advantage. And in the end, what we choose for is usually low cost. And that's what we're going to be debating afterwards, because low cost and transparency do not appear to be the same thing all the time. Yes, we like a level playing field. I've heard all the right things. Capital Markets Union Action Plan, the market structure seems skewed a little bit towards institutional investors. We are at a disadvantage. We will come back to this. Consolidated tape is something that you capture with high-tech tools. There's so much information. By the time individual investors get to it, there's a latency. We're late. And the goal seems to be for everybody to have more people, retail audience, participating in the economic structure of our society. So I'm going to come back to this several times. How do we do that? When we know that an investor is typically on this borderline between regulation, control, risk-free, and innovation, chaos, which is typically the markets. How do we find a balance between those two? I've heard Alexandra say some really nice things about the increased non-professional investors. It brings liquidity to the market. We only have about 20 to 30% of household investors of household wealth invested in Europe. Can that be more? Should that be more? These are all questions, of course. And in the end, like I said, I'm a bit stuck in the middle here, but I'm sure we are not clowns and jokers to the left and right of me. So.
Little American pop culture to anchor your expectations. Next we go to Christian.
Hello, my name is Christian. I'm a co-founder of Trade Republic. Before that, I studied philosophy and history of art, so no clue how I ended up here over the previous years, but obviously now it's great fun. First of all, thank you for inviting us as a young company. It's a huge privilege to insert our voice into this dialogue, right? We know it's normal, so thanks a lot for having us. I reckon many of you may not know Trade Republic, so let me give you just a quick overview of who we are, what we do. The company operates since 2019. We're basically offering two products to the people. First one is commission-free, self-directed trading. If you're a European citizen, you can open up an account and you can buy a European, American, Asian stock commission-free in our platform. The second product are so-called savings plans. You can subscribe to a monthly installment to, for example, an ETF, and again, invest for free in there. Today, 3 years later, Trade Republic is the largest savings platform in Europe and amongst the largest brokerage firms in Europe, operating amongst 17 member states today. Let's talk about the people who are using Trade Republic, because I think there's some myth.
Can we talk about the regulations?
Sure.
Great.
Oh, but there's, I think, an important bridge to talk about the people, right? So our average customer is 28 years of age. Our average customer is a first-time investor, and our average customer comes from the core of society. I reckon the motto of today and the aspiration, I think, of all of us of making policy is to make a capital markets union that works for the people. So let's talk about the people. The people have an average savings budget per month of 300 euros. I think we need to be very honest about the fact that the system we've created over the last 30 years is not empowering the people to invest. Why? Because this system has brought up what I like to call today monopoly exchanges, suppressing monopoly cost to the people. If I at Trade Republic want to wire a trade to, for example, the German stock exchange, I need to pay 4 to 5 euros in fees, market entry fees, clearing and settlement fees. That has been the system for quite some time. Now, luckily and thankfully, regulators have pushed competition amongst trading venues. That competition has led to the fact that those costs were going down. Trade Republic is not wiring the trades to this stock exchange. It's having a known exchange, Stock Exchange of Hamburg, which we're working with. There, I have no market entry cost, I have no clearing and settlement cost, I have no cost for the market data. So I can execute the stock trade for free. And I do get something back, payment for order flow. Payment for order flow is the competition mechanism which has decreased the cost per trade execution massively in the last 5 years. And that is the reason why Trade Republic could accumulate over 1 million customers across all Europe, 17 member states, and represent a new first generation of European people to participate. And their future is very important because we face historically low participation rates still globally. We face a huge pension gap, and it's important that these people really participate. So I think the bottom line is, with the discussions at hand, we're reversing that trend. We're manifesting monopolies, cost will rise again, and that will hinder people to participate in capital markets. So if you want to build something that works for the people, I think we need to go back to the drawing board and really do a deep dive impact assessment and see how we can utilize things like the consolidated tape to create transparency across exchanges and enable the people to invest better.
Thank you. That is actually a really great introduction to payments for order flow, which we will come back to, which would seem to really show the tension here, because you're sort of saying the way to get around monopolies is to create alliances, and that this is how we're going to share the costs around. And I'm going to chew on that for a little bit. While we're thinking, we have Salvatore from ESMA to give us a sense of the scene.
Yes, thank you very much. Thanks also to Better Test? Yes. Okay, that's perfect. No, so I was saying that the topic of this panel is retail access to market data, which is usually actually a topic that we always hear in wholesale directed panels or conferences. So thanks to Better Finance for bringing this also in the retail context, because indeed retail access to data in general is important. Now I would like to link me back to the previous discussion, to the previous panel discussion, which is the one on the retail investment strategy. So as one could expect from the first panel dealing with it, the discussion was polarized around the inducement debate, although there are many other things in this package, and a lot of these things are also about data, data access to data by retail investors, access to data on cost, on information, on risks, exploiting the possibilities, the opportunities offered by digitalization of services. And so I think that, Guillaume, we should probably have an additional conference to discuss also about the other aspects other than inducements and all the various proposals which are part of the retail investment strategy. That being said, there is also an element there, which is a part of any policy making in the retail area, which is the ability of retail clients to absorb data, the ability of retail clients to understand data, which is also something which is very interesting and which brings us also to the issue of financial education, for example, which popped up this morning and in the previous panel and is already popping up during this panel. But as I said, probably this panel is more on the pure market data, which is probably part of another legislative package today under discussion, which is the MiFIR review package. And in reality, both, as the Commission was recalling this morning, both the retail investment strategy and the MiFIR review, they are all part of the CMU package, the CMU strategic objective, which then reminds us that the ultimate objective of these legislations, being the latter or the former, is actually to make capital market work better for society and also for investors. What does it mean? This means that on one end we have companies which have difficulties in accessing financing. They have to rely on banking credits, and they would benefit clearly from having more direct access to investors funding. On the other hand, we have investors who in reality do not, so today, as it was reminded this morning, they largely invest, if we can say so, their own money in a banking deposit, which often do not even remunerate the investment. This is why, again, this is where also the CMU may make the difference, and therefore we should all collectively reflect on how the retail investors' access to data may help them to make the right choice. Now, I think that during this panel, we will end up discussing about large-scale waivers and systematic internalizers, the CP, the CT, the consolidated tape, and how this can contribute also to better services to retail clients, and of course, PFOF, how a business model which clearly is based on a conflict of interest can also serve the retail clients. So I'm also keen on listening and learning also from the other distinguished panelists on how we can also work further and better to improve the retail access to market data. Thanks.
Thanks for that. Ben, to come back to you, I think I have a question for each of you going back down. What is your take on payment for order flows? Should it be more transparent? Does it work? Do there need to be just more sharing and more consolidation? How do you see this?
It does, but it should. So everything is connected, as we've seen before. For the end investor, the fact that we can do cheaper trades is a real benefit, but the fact that we cannot be sure that we do a benefit is a problem. So I would like to say we trust in the best intentions of everybody on the panel here, and I've used that platform, and I'm quite convinced that I have benefits trading through that platform, but I cannot verify. And isn't that the essence of what we're trying to do, the transparency that has to build a trust, that has to convince more people to invest. So if we can do that, then I think it's noteworthy that it was Jean-Paul Servais who started for the first time today about sustainability. Let's not talk about the E, but the S and the G is exactly what this regulation is all about. It's about the social and the governance of the exchanges that we use, and how we use them means that we will have to build trust, have to build education, so that we all, not just because a Trade Republic is here and we've used them and we've known them and we like them, but that we can have somebody verify that your colleagues in maybe other places do the same thing.
Christian, let me ask you, do you think that there should be a clearer demarcation between products that retail investors should have and products that they should just not? We have a better finance proposal to restrict dark capital market venues to really big trades, just so that you don't have mis-selling.
I think that's a question which is a bit differing from what's actually about. So I think at Trade Republic we're offering regulated, governmentally oversight, exchange-based trading, right? So it's not going into a so-called dark pool or whatever.
But the question is, do you think that's good, or do you think that you should be able to slice and dice it and create a fund out of it, or that someone should, even if it's not for you?
No, I think as retail client, I want to have a product which is transparent, which has a general oversight, right, and where I can see with certain transparency what's happening, right? And that needs to come at a cost which I can afford, right? And I want to build a bridge here from what has been said earlier about this quote-unquote conflict of interest. I really struggle to see this conflict of interest, and I think we're taking a concept which is well understood in the advisory aspect of this debate into now the execution side of this. I don't see this conflict of interest. MiFID II gives us a very sharp tool of assessing the quality of the offering, right, which is the best execution. Best execution is two factors, implicit cost and explicit cost. This debate has been too much focused on implicit cost, right? But we need to talk about the explicit cost. If we again talk about the people, the person who can only invest 500 euros, which is the median trade size at Trade Republic, then this person doesn't really benefit from any plus or minus basis points.
Does this person need, or would it be a good idea to give them access in the market to some of these large pools and things like that in the name of freedom, or is it a good idea to keep those separate because it's not an appropriate product? That is the question.
Yeah, I think that's maybe rooted in a misunderstanding what Trade Republic is really offering.
I'm not asking you what Trade Republic is doing. I'm asking you what think of the policy.
Yeah, apologies. So again, I think the trading should happen on a regulated device where there's oversight, right? And I think we're well advised what we're doing today to bring more transparency to it. And I do believe that there are certain market venues, I think the one you mentioned, which maybe are not as transparent and therefore not in the best interest of the clients.
Thank you. Henrik, you talked earlier about the role of retail investors in price formation, which I thought was really helpful. How do you see maintaining equitable access? Do you think that building these relationships, you know, in terms of payment for order flows is a way to do that, or do you think there are other ways to get that engagement?
Yeah, indeed. The retail participation into the lit order books where the price formation basically only there happens is key, especially in the smaller companies where in the Nordic markets we have some evidence showing that up to half of all daily trading is done by retail investors. And now anything threatening that obviously is quite serious, considering that if price formation deteriorates, that actually means that the cost of capital for companies goes up. And even the valuation of companies takes an impact. So we are very much here to protect all investors actually joining the price formation process, maybe excluding then the large in scale, i.e. the larger interests, where due to market impact there is a solid reason to maybe allow trading in dark pools and also in these SI arrangements. But certainly then in terms of payment for order flow, I think I have to comment on that. I mean, I think there are good analysis done on the outcomes from models using payment for order flow, clearly showing that the investor outcomes are worse. I mean, there are no free lunches. If you see something for free, then you are easily the product. And I think the same applies quite often to payment for order flow. And these studies, by the way, I think they are done by the regulators, so they should be trustworthy and neutral. So they basically showcase that the trade price, it's not what would have been available especially had you posted a passive order into the lit order book of the most liquid primary markets. So comparing against that, payment for order flow models typically or average result in a worse outcome. You end up actually paying more for your position. So I think it's certainly a solid direction where the EU is now going with the ban on payment for order flow that hopefully actually will be now agreed on in the next couple of days. I hope in these trialogue discussions between the Commission and the Council and the Parliament.
Thanks for that. Niels, would you like to respond to anything you've heard go by and then maybe set us up for a discussion of consolidated tape? And I will just say that I would really appreciate hearing from you on the panel. particularly about the relationship between the consolidated tape and retail. It's very tempting to start talking about the back end and sharing data and all of that, but if we can keep the focus, and this is just a general plea, on how it gets to the end investor, that will help. But first, the floor is yours.
Thanks so much. Yeah, and I think everybody who knows me knows I'm a very chatty guy, so there's always plenty of things I would like to react to. I think on payment for order flow, and Christian nicely set the scene from a Trade Republic perspective, I think for me personally it's always important to remind ourselves where the invention in itself came from, right? And it's traceable back to Bernie Madoff. It's a guy who many of us remember in financial history as having operated the biggest financial snowball system ever. He's, by the way, still alive, sits in jail. And I think that the studies carried out by CNMV in Spain, the supervisor, or also the Dutch supervisor, AFM, two brilliant pieces of work based on empirical transaction data, actually show that beyond 80% likelihood that any of us will be executed with worse outcome and worse quality when using payment for order flow. Clearly, there is a big difference between looking at explicit trading costs versus implicit trading costs. And yes, you can, as Hendrik and Christian put it, you can assume that if there is zero costs for trading and if there is a free lunch, then for me at least personally, all my alarm bells are going on. I think there's also, of course, a truth to that dimension when you then sort of look beyond some of the conflicts of interest discussions, execution realities, and so forth when it comes to market data. And I think it nicely transitions us over also, Rebecca, into the consolidated tape and market data discussion. Because one thing Christian said is that these evil exchanges are all monopolies and vertically integrated, right? So to begin with, the first observation I would make is historically probably important to bear in mind that exchanges used to be public animals, right, and not private ones. And there was a good reason why we all collectively, from a societal perspective, said makes sense to have a central marketplace. Because if we go back a few hundred years, then it was probably better for the farmer to come into a central marketplace and see what the farmers right and left would get for their crop. And that's what we call price formation. That is, we do not want to see information asymmetries in the market, because that's very decisively used by better informed investors over others. And that's also when we look at market data, and you can see this also being reflected, by the way, in a very good analytical piece Better Finance published a while back on the availability and accessibility of market data, that stock exchanges generally across all of the European Union were always publishing the data for free for retail investors with a 15 minutes delay. Now, many other execution venues that I was talking about earlier that are not exchanges or to a certain extent MTFs will not give you this data. They will not even give it to you for free. They will not give it to you at all. Actually, it took me quite a while, and it was quite a lot of meetings with a lot of supervisors across all of the European Union to make sure that alternative trade execution venues would actually provide proper market data reports, because it's quite interesting that you even see highly intellectual investment banks doing a bond trade, but then submitting, for example, a market data report on equities. Quite a mismatch for me. And that's also important, I think, when we fast forward the wheel now to reflect on the consolidated tape. Why so? Generally, we've heard so many interests all over the place in terms of the importance of a pre-trade tape, and that a consolidated tape would only be viable if it is with pre-trade data. From a retail perspective, three simple reasons why this is a very bad idea. First one is really latency. That means the tape will in any case be always slower than low latency feeds that you can otherwise obtain. So you create clearly a two-tier market where people that can afford faster market data will have an advantage over the retail investors. Second point for me is really accessibility of what you see in the window. Now, going back to my example of 250 equity venues across the EU, the interesting point is many of those, some 200 plus, have a discriminatory rulebook. So that means even if Guillaume, I see you sitting here, even if Guillaume sees something on a pre-trade tape and says, that's great. I want to trade my Siemens share on venue XYZ. That doesn't mean that he can actually access this, because probably he would have no way to route the order there. The third point for me is a very simple one, and that's human use case, right? If we all consider a real-time pre-trade tape, and we take the example of my Siemens share, you can trade this across 100 different venues nowadays in the European Union. So that means Guillaume will sit in front of a screen and will see 100 price knots on the same instrument constantly flickering and updating in real time. Now, I would tend to say you will have very little chances compared to algorithmic and computer trading, and that's why I say start with a close to real-time tape on the post-trade side, have an EBBO snapshot injected into this, so that very nicely, from a retail perspective, you can actually see what would have been the price you could have gotten on the pre-trade side, what is the actual best execution analysis on the post-trade side, and what did you really get. And that's a good starting point. I think we can also all agree this would be much faster to implement, much cheaper to implement, where we also have a nice connect back to the costs of market data. And I think once we actually have some experience with a consolidated tape in the European Union, no one says that we couldn't sort of enhance it in future, make it better, and potentially also explore the pre-trade side if and as needed. That's where I would stop, Rebecca, and hand it back over to you. Thank you.
Christian, I see you would like to respond to some of the ideas.
Yes, of course. So first of all, I think you are hitting the right spot if your competitor needs to quote Bernie Madoff, right, to make a point. No, so let's talk about PFOF. I think we need to demystify this entire thing, right? Payment for order flow is a competition mechanism between exchanges. We need this competition because the explicit cost on the monopoly exchanges are too high. 3 to 4 euros they need to pay for the clearing and settlement and market access on this exchange. We have a good instrument which is called best execution. And let me walk you through the 2 points of best execution: implicit cost and explicit cost. Implicit cost. The two gentlemen have said that it's clearly obvious that there's worse spreads. I don't think it's obvious. Trade Republic themselves have opened up their books, have hired 2 renowned researchers, working with Deutsche Börse, by the way, all the time, who have found out that our spread is 43% better than there. 43%. Our clients for a 1,000 euro order are saving 50 cents just by implicit cost. Because of the order sizes we're having, it's a better market. Thus means in 2021, our clients have saved 6 million euros vis-a-vis doing the same trade on the Deutsche Börse. And this is only implicit cost. So implicit cost is already better. We can debate the techniques how to evaluate this. I clearly agree, and I think we see eye to eye that the post-trade tape would be the right measurement to get a European best bid and offer tape and have this data to assess the quality of their trading. And then we have open books across all Europe, and don't need to debate this point anymore here on stage. But let's talk about the explicit cost. We cannot shy away from the truth that routing an order to one of those exchanges costs these 4 to 5 euros. And those 4 to 5 euros are a deal breaker for the average person. They cannot invest for these costs. We're preventing them from participating, especially at a young age, where it's most important.
So do we need consolidation, cross-border consolidation?
No, I think we need to have a competition of market venues, which is clearly driving down costs, as we have seen in the last 5 to 6 years. And we need to have one consolidated tape on a post-trade basis, which is a great measuring stick for the quality of what the clients are getting. But maybe if I want to stick one sentence, Trade Republic today is for the average household in Germany the best execution venue for the majority of stocks.
It's interesting that you picked Germany, because that shows you a specific relationship between a specific geographic place and a specific geographic exchange. And I don't think it to me anyway, it raises questions about a capital markets union, about the cross-border options and for people in smaller member states. A question I have, and I don't know the answer to this, but that I hope we can tease out, is how to make this more accessible to everybody and not just rely on consumers having access to somebody in their market who does this.
And that's actually the point that I wanted to bring up. I agree with most of what you say, and I do see we're moving towards a solution, but right now, why are we on stage? Because there's a proposal, and that proposal is a compromise up to the point it is now compromised because it has opt-out options and it has lack of evidence. And so what we are aiming for is to find out if this regulatory proposal on the table is actually helping us move towards open books, transparency, level playing field or not. I have a problem today seeing how it will, because it has these opt-out clauses. That said, if I can switch sides within one sentence, I agree that for some exchanges the cost is too high. I agree that for some internalizers there's not enough transparency. How to fix it?
Thanks a lot. So it will not be a surprise that from our side we support more transparency. This means that we have been adamant that, for example, in the model of SIs, we support clearly additional transparency. The Commission has introduced something in the proposal. Let's see how things go in the trilogue. So we have to consider that in the original logic of the SI model, it was to make some dark pools emerge, basically. Before MiFID II, these intermediaries did operate without declaring themselves as venues. So one of the objectives of MiFID II was to bring them to light. The only point is that many people would have expected them to become a multilateral platform. In reality, the model chosen was SI, and therefore more transparency is needed without any doubt. On the consolidated tape, again, I don't think that I'm revealing any secret that by saying that we fully support the consolidated tape. We think it's very helpful for investors, but also for intermediaries. And this brings me back also to one element, the element of best execution, which was mentioned. So best execution currently is based on quite complex metrics in some cases. Assessing best execution is not always so easy. This is why we also believe that the consolidated tape may help also intermediaries to assess and to demonstrate best execution to their own clients. And in this respect, you may be aware of this debate on what it was technically called RTS 28, which was basically the reporting that intermediaries were and are required to publish on how they have made the choice of the venues where they execute. We believe that the consolidated tape may benefit also the way in which this reporting is made, and we appreciate in the trilogues, in the negotiations, in the political negotiations, this possibility, this technical standard is still there, this obligation to report by intermediaries. I would stop here for the time being.
Henrik, do you have anything you'd like to add?
Always. Maybe just on the tape question. I mean, we certainly at NASDAQ we support a pan-European tape. It's going to help, but will it be a game changer? No. And as evidence, I mean, looking at the Nordic markets and the Baltic markets that NASDAQ has been operating for 10 plus years, we actually have a tape there. We have a single tape, we have a single data center, so no latency issues either. We have a single trading system, we have a single set of rules for all these 7 markets. And by the way, the price point for the tape for retail investors, real-time tape is €1 per month. That's typically covered by the broker. So the retail investors typically in the Nordics, they don't pay anything for real-time access to market data. Now, has that made an impact in terms of the way people invest in the Nordics over these 10 plus years? Sorry to say, not really. We don't see any more cross-border investment between the Nordic countries, despite the cultures being very, very similar. But despite this, despite having a tape, despite having the same system, there is still a huge home market bias, especially when it comes to smaller SME companies. We might have Finns buying into Ericsson or such, more known companies from the other Nordic countries out of Finland. But yeah, the tape, we shouldn't expect too much from it, especially as on a moving from a Nordic level to a pan-European level. We then have these latency aspects, as you know, Euronext is having a data center in Italy and Deutsche Börse in Frankfurt, right? And then we have it in Stockholm and so forth and so on. So these geographical differences in the data center location, it's just physics. There is no way for us to create a real-time tape in reality. So we should accept that.
Do we have any questions from the floor? While you're thinking, I would like to ask the panel about other things besides equities that retail investors might want to invest in. How does that intersect with some of these issues of silos and data access and transparency, and what do you think needs to be done? Christian, do you have any thoughts on that?
Well, so I think it's a layered question, right? So obviously I think stocks and equities are on the core of the debate mostly, then we got ETFs, and then we got structured products, right? I kind of exclude structured products like derivatives from this discussion because clearly 90% of people are not really buying them, so I think that's not something which is the area here. I think on ETFs we see that they're...
And bonds?
Yes, and I think the bond market, the bond market is equally important. I think recently, since we see the ECB hikes, it's clearly a product which is very compelling to retail investors these days. Costs are as high as they've been for equities here, right? We see the liquidity is quite fragmented, right? And it's hard for retail people to see how much they can invest. Plus, I think there's a minimum distribution size, which makes it quite hard for people to invest. So, unfortunately, I believe bond market is a different, like another question for another day, right? But I think the urgent problems to solve as well, because clearly today the middle class doesn't have really access other than their homegrown government bonds, I'd say.
Maybe first take one step back, that Better Finance actually supports the text put forth by the European Council, meaning that we understand the problems to create a consolidated tape that really encompasses all different types of investment and all different venues, and therefore to offer a choice of lit venues might be a good solution, whereby if internalizers are sufficiently lit to be transparent, we might not even have a problem with that. But the tape for us is not necessarily to be consulted by the end investor. It should help with holistic supervision rather than holistic transparency. Again, because simply we do not have the capacity to interpret this mass of data coming on. And this leads to the, for instance, the bond market. The problem is not necessarily availability of data, but access. We find, and this is maybe more on the Belgian market, as an individual investor, I cannot buy the bonds I want to buy because the venue simply will not offer them to me. Is this a result of the regulation? Then I have a problem with the regulation. Is this a result of the choice by the vendor? Then my problem is with the vendor. But this is the same idea for any investment, whether it be a crypto. Why couldn't I, if I wanted to, which I do not want, but that's a different discussion, if I wanted to buy cryptocurrency through my normal broker, why is it not available? If this is a bad comparison because it's a dark pool, then say the same regulation should count for all these investments, bring them to a lit venue, and my problem is gone.
Yes. So, the first comment is that, so to clarify that the regulatory framework does not pose any obstacle to retail access to bonds or to any other instruments. So the regulatory framework is neutral in this respect. So this is important to say because in some cases, the rules, the requirements are seen as the cause for restricted access to certain instruments. But in reality, if we go and look to the rules which are applicable, the requirements which are applicable to different types of instruments, the requirements are basically the same. So when it comes to deconsolidate tape or to enhance the transparency, therefore, the same that I said before, our full support for both also applies even more to bonds, obviously. And I would like also to add that obviously we would support any model in which the consolidated tape is accessible for free by retail clients.
I think we're waiting for the commissioner to arrive, so when I see her come in, I will wrap up the panel. But in the meantime, unless I hear from the organizers, we will keep talking. Your questions are welcome if you have them. And I would like to ask, yes, question back there. Question in the front also? No, question back there.
Something that is interesting from a retail investor perspective.
Did you say you want the vendor or the regulator to be handling the regulator? That's what I thought. So
as long
make
as
the connection.
we have, as long as we can understand that this is a trustworthy product and a trustworthy investment, and it has been checked by the regulator or market authority. In the end, for the retail investor, what matters is, okay, I have 200, 300, 400, 500 euros I can invest each month. What's my best option? There's obviously the whole advice part of things, which we discussed in the morning. But in terms of cost and quality and transparency and transaction and best execution, most of these things are beyond what we need, beyond what we want. But what we do welcome here, for example, with the impact of Trade Republic is that there's disruption, that there's this question, there's a different business model. We have our doubts about whether we can trust it, as I think, again, was Ben was saying earlier. But this seems to be going in the direction of the investors' interest. And so as investors and as a community, we're keen to explore that and see how much we can trust it. And I think that transparency, but not for the retail investors, but transparency so that we can then get a good opinion from the regulator or the authority to see whether we can trust this approach or this new business model.
Thank you. Do you have a question?
Can I react to that first? Oftentimes the regulator is misinterpreted and misunderstood. And I will say that Monsieur Servais has been a consumer advocate in Belgium, which is not always the case because we have all cursed at him at several occasions because the regulation, that the effect that it has on our actual life is not what was intended. So we actually trust the regulatory movement. We love working with ESMA. But there is a clear divide between a commercial logic and a regulatory logic and an end-user logic. Therein lies the problem.
And if I may follow up on that, do you think more common supervision would help throughout Europe? More EU-level supervision as opposed to national supervision?
Well, we are a fan of the common market, so yes, it should, if we all have the same possibility. And I agree, as a psychologist, that a home bias is never going to go away, but still, if we consider, for instance, something like Euronext or Nasdaq or as our home exchange, maybe then the universe, the scope widens anyway.
Do you have a brief question?
Yes. So what we'll be interested to know is what is the path to getting there? So having basically clarification of what's going on right here on the panel between the experts. Like, how do we move forward to figure out the trust we can have in the business model that Trade Republic is bringing here, ways to have basically best execution for the investors. These, I think, are where we want to get, and so I'm interested to know what would be the path there.
These are good questions. How do we get there? And I guess as we come back, I'd have two questions for this half of the panel. One thing I hear a lot is we'd love to have common supervision when it's ready, but you know, we trust our home regulators because we know them, and common supervision maybe isn't there yet. So how do we get there? How do we get that trust? And then on a different track, I'm also interested, you mentioned exchange-traded funds. Is that a way to bridge the gap between bonds and investors? If you have an ETF of bonds, is that a way to make it work? So Niels.
Yeah, I mean, that would have been my answer to your question as well. Take the ETF example. I think it's a great innovation by exchanges in showing how you can really make the financial system more effective, and that means lowering costs and increasing the returns. But the interesting point is always going back to market structure. And yes, many may call me a market structure geek, but the it's really sort of the root of many of the things we do as per design. And so concretely, when you look at ETFs, 70% of all ETF volumes in the European Union are traded not on the exchange. Right? And that should always lead us to ask, why is that actually the case? And the answer will always be found, again, in information asymmetries and, of course, the profits that certain interests in the financial system drive by essentially taking these products back off the exchanges. It's a bit, if you will, so comparable to the bond realities, which I think is a discussion that receives too little attention from a retail perspective in particular. We've seen a strong and steep interest rate change, so bonds are de facto becoming very interesting instruments again after a long period of zero yield or even negative yield. And also there, I would tend to say generally the problem lies in the market structure, right? Because you will not find central exchanges that have a dominant footprint on fixed income in the EU. This is traditional business between the banks, right? So there, I think, is a lot to change, a lot to really consider in the years to come. And it's mainly for me really around market structure and transparency, and that in turn should always result, hopefully, in that trust that you mentioned, because it's a key ingredient of capital markets, of course.
Christian.
Yes, so I think there was a statement like, yes, ETFs are not happening on exchange, right? And I think for me, my humble opinion is because you're too expensive. That's why it's not happening there, right? Because people, ETF savings plans want to have them for free. They cannot pay 3-4 euros explicit cost to invest there. And I cannot leave today without making at least one humble prediction about what might happen. So I think now with the rule, which is likely going to be voted for, we're going to ban payment for order flow, national opt-ins or outs here or there. But we're going to meet back in a few years' time, and we're going to see that retail investors are going to pay more for the same trade than they do today. We're going to see that liquidity providers are going to make just more profits because they're going to keep the money to themselves. We're going to see that exchanges, some present here, we're going to make more money. So what we're doing is we're redistributing profits from the retail people, from the average people, into the pockets of corporations. And I think that's a mistake because I think we need a proper impact assessment about what we are doing here. It's a brutal intervention about something which has been built over the last 4 or 5 years. And I think the European Best Bid and Offer and the consolidated tape is a humongously important tool to do that assessment. So I would urge every decision maker here today, just take the time, take the tape, assess what's really best execution for the people, and then do a decision. We've seen an uprising in retail participation of stock ownership in Europe, and that's a small plant. And I think we're endangering of destroying it.
Yeah, so on this ESMA compared to the national regulators, I kind of like the current setup where ESMA is there to make sure that we have a level playing field, but still local regulators per country are there then closer to the ground, ensuring that all local aspects are considered when passing judgment on how things should be. But then to the question on how to very important question, I think the key question, I mean, how to ensure we have confidence in the offerings available to retail investors. I don't have a full answer, but I think further analysis by neutral parties like the regulators would help. I mean, as said, things have been done already. I think it was it the French or the Dutch regulator, or maybe both? They did a pretty extensive analysis on impact of payment for order flow compared to trading in the lit order books, and again, that evidence was to me at least very solid, leaving no doubts. Whereas then the other analysis that was referred to, and correct me if I'm wrong, but I believe that was done to a large extent based on US listed stocks traded in Europe, where of course liquidity in the European order books, in the lit books, is obviously not what you see in EU-listed companies. So I think that certainly had a huge impact on the results of that survey. And maybe Niels has more details on that.
Yeah, no, I think for me it's also just an addition to some of the remarks made by Christian. You know, it's not about explicit trading costs, it's about total costs you pay. And it's great if you can pull up at a gas station with your car and get your tank filled for free, that's cool. But if you actually have to pay 50 euros every 10 meters that you drive, that's probably less cool because the total costs are actually higher than just paying for the fuel. And this is exactly what the discussion is about. The second point for me is really about reminding everyone on the big problem we have in the ecosystem of equity markets in the EU. It's a discussion that is then often forgotten. It's pushed into technical conversations on the Listing Act and so forth. But the reality today, yesterday, and even more so tomorrow is that EU companies are leaving the EU equity markets. They get listed abroad. They get listed especially in the US. Hopefully London will have a chance as well again in that regard. But I think the core observation here is really that we have regulated in a way that it damages the ecosystem of the equity markets and its underlying, right? And that is a core reflection we should take very seriously, because it means our companies get lost. We lose the jobs here, we lose the tax income, and very importantly, of course, we also lose our chances to participate in the value and growth creation.
Thank you for that. I see that our next speaker is here, so we will wrap up, even though I have more follow-up questions I could ask. It's the joy of being a moderator. There are always questions. Thank you all. Salvatore, do you have any final comments or anything that you'd like to come back to? No. All right. Thank you all for your participation and your interest and your questions. I look forward to hearing from Commissioner McGuinness, and wish you all a very fine rest of your conference. Thanks.
And now, a keynote speech nobody has been waiting for. Apparently, the room is very full. And a person that does not need any introduction, Commissioner Mairead McGuinness.
So, a very good afternoon. Thank you for the short introduction. I would that more people would adopt that as a strategy, because there are times when your entire life is read out before you, and it can be embarrassing. So happy to be here with that short intro. Oh, and also I'm happy to be here because I want to acknowledge the role of Better Finance in supporting the work we're doing inside my cabinet and my services on retail investment. So I want to put that very much on the record, that Better Finance has been a steadfast supporter of work in this area, and you have consistently made sure that the interests of retail investors are represented here in Brussels, where decisions are made and which impact 27 member states. We share a common goal in this area, and I've always appreciated your views and your support. So this event is an opportunity to highlight the work around the retail investment strategy. So what I'm going to do today is try and paint a picture of how things might be, in fact, how things should be and could be with our policy that has just been adopted. And then to look at how the world is today, so the real world, and how our retail investment strategy can get us to that better place. So one of the words I have on my screen is I have a dream. And I'll tell you when the dream ends and I wake up with the reality. And the dream, the vision, is to see a very strong retail finance culture in Europe, where all citizens are financially literate and where they're included in the financial system, and where they don't face unwarranted barriers to access, and that their interests are looked after. And that means a retail investment culture where financial institutions work to eliminate barriers to entry. They enable wider financial inclusion, whether someone has a lot to invest or just a little. So financial providers would offer a wide range of different products and services, and that would mean everyone could access a suitable product, no matter your means or your background. So in this world, this vision, providers would offer different products tailored towards different needs, different goals, and different appetite for risks, and always and consistently act in the best interests of their customers. Retail investors would be able to easily choose between different providers and the different products on offer based on what they want to do with their money and their own particular goals in life. They would rely on clear, comparable information about different products, information that would show them the likely return for different products and the risks involved. And that information might be available on an app, and increasingly it might well be, but also, if it was required, on paper, depending on the preference of the citizen. And in making their decisions, retail investors will be able to count on fair, unbiased, and easily accessible advice. And that advice will be available at a fair price. So when navigating this system, retail investors will be able to trust that they would be covered by strong protections and consistent rules. If I look to young people in particular, I would really like to see young people engaged and confident and benefiting from financial education from a very young age. We know young people are on social media, and indeed some of us who are not so young are on social media. But we also know that in that world, we need to look at the regulation of social media influencers, so that they're not providing misleading information. And this is an area where I think our regulators and supervisors have a focus. Again, young people would have a wide range of youth-friendly investment opportunities, like low-cost investment accounts tailored to their needs and interests, and of course protecting them from taking too many risks at a young age. Looking wider, we would enable everyone to be financially literate, to be confident, to be able to ask the right questions. And that will come down to widespread financial literacy programs that are targeted towards the different needs of different social groups and different income levels. So that's the vision, because I really want citizens to make the most of their hard-earned cash. And indeed, cash is something that may come up in our conversations. We're seeing major changes in how we live, work, and play. If you look to that younger generation, they're changing employment patterns. People will change jobs many times during their working life. We know there are pressures on pensions, and we need to start thinking and talking about pensions from a much earlier age. We have a greater number of smaller households and more women who are the main breadwinners of their family. We're also witnessing generational shifts in the way people invest. This young, tech-savvy generation, they're using new opportunities that come with apps from banks and investment platforms. And these are easy to access, and they have a low-cost access, therefore, to investing. And in one sense, they learn by doing. But there is a but here, because those who are using these technologies may lack safeguards available to an older generation. With these changes happening, retail investment, in my view, is now more important than ever. How to get retail investors more engaged and how to get more retail investors is really the core part of my mandate as Commissioner. But it's also essential for the wider mandate we have around developing Capital Markets Union. And to put it very clearly, we won't have Capital Markets Union without retail investment. Through capital markets, money can be reinvested into businesses and made to work for the broader European economy. And indeed, with our focus on green and digital, we do need to have more money flowing towards those parts of our economy that are moving towards greater sustainability. Now, unfortunately, the reality of today is very different than that vision that I've just portrayed. And when we were preparing the retail investment strategy, we did pull together a great deal of evidence and information, and it is and was a sobering exercise. We lack the dynamic, confident investment culture that other developed economies have. Retail investor participation in the EU is low by international standards. Just 17% of EU household assets are held in financial securities, and that compares to 43% in the US. Our levels of financial literacy are also low. Too many EU consumers just don't understand enough about their finances. Now, there's lots of ways you can measure that, but in one measure, which was conducted by the OECD, Their studies show that on average, consumers could only answer about 6 out of 10 questions on very basic financial concepts, behaviors rather, and attitudes. And all this means that retail investors therefore rely very heavily on the advice they receive from intermediaries. And here, unfortunately, evidence also points to the low trust people have in advisors, even though they know they have to use them because they don't feel confident themselves to make decisions. 45% of Europeans are not confident that the investment advice they receive is actually in their best interests. And they don't trust capital markets much either. The Commission's Consumer Markets Scoreboard generally ranks investment services among the services that consumers trust the least. And that might be related to the finding that retail investors often don't get the best deal. The products they're offered tend to be expensive. They pay 40% more than institutional investors. Certain products on the market, especially more complex ones, carry higher costs, especially those where costs relate to inducements. Higher costs mean lower net returns, so it's hardly surprising that many people with money to invest don't actually invest. And again, if you look through COVID, people saved a lot of money in bank deposits, and at the time it wasn't returning a great deal to them. They also put it into property, into other projects, or as I said, just leave it in the bank because it's there rather than because it's working for them. Now, if we want to develop the EU's capital markets, we need to address the shortcomings that are holding back retail investors. And that is what the entire purpose and focus of the retail investment strategy sets out to do. And again, to mark my appreciation to Better Finance for all of your help. We want to build the case for an ambitious, broad-ranging strategy with the consumer at its very heart. With Buick and Finance Watch, Better Finance has championed the interests of retail investors. You provided evidence and arguments that served as an important counterweight to the financial sector, because we need that balance. There was particular evidence in the debate around banning the payment of inducements to advisors, and this, in fact, became the focus of a great deal of the conversation before we adopted the proposal. You provided evidence on how inducements can skew the retail investment market towards more complex, expensive, and poorer value products. Now, I know very well that you may be disappointed in the fact that we didn't announce a full ban on inducements, but we've worked our way towards still holding this on the table. And I want to reassure you that we listened closely and carefully to all of the evidence and arguments you provided us with. But we did ultimately step back from inducing a full ban at this stage. And those of you who would have read my speech at Eurofi will recall its contents. Because we recognize the detriment to consumers from the commission-based system of distribution. But we also recognize the potential disruptive effects on the market if we move too quickly to an outright ban. We know the status quo does not serve consumers. And because we discussed a ban on inducements, the financial sector now acknowledges that the status quo doesn't work and it needs to change. Now, for me, that represents considerable progress. And we will be holding the financial sector to its commitments to improve on the situation as it is today. So really what we've decided on is a staged approach. In the first instance, our proposal introduces a ban on paying inducements where no advice is provided. It also strengthens companies' obligations to act in the best interests of their clients. And it strengthens transparency requirements where inducements are paid. Secondly, 3 years after the adoption of the proposal, we intend to review how the rules are working and to assess whether extra efforts might be needed. That means an inducement ban remains on the table for the future. In parallel, we are organizing a roundtable with stakeholders to start discussions on how the situation for consumers can be improved through industry efforts. And we have invited Better Finance to join in this conversation with us at the roundtable. Looking beyond inducements, there are many other important measures in the strategy, and I want to make sure that they get the attention they deserve too. So firstly, information and disclosures. We propose measures to improve how disclosures are made to potential investors. We want retail investors to have access to clear, comparable, and easily understandable information. And that information should be available digitally, if that's what an investor prefers. Second, if I turn to the value for money issue, some products sold to retail investors include costs that are much too high. And those high costs mean there is little or no chance of making a positive return. New rules will mean that providers have to assess whether their products offer value for money based on set criteria and objective benchmarks. And providers will only be able to offer products if costs are justified and proportionate to expected benefits and risks. Third, tests on appropriateness and suitability. These assessments have to be conducted before a retail investor is offered a certain product. But there's far too much variation in how these tests are carried out, which means that retail investors may end up buying products that aren't the best for their needs. So here we're strengthening the requirements around these tests. But we're also simplifying the tests when they concern simple, cost-efficient products. And that will encourage the provision of independent, cheaper advice. And fourth, to financial advisors. The situation today is that the qualification and skills that you need as a financial advisor vary greatly. So we're setting common standards across different laws and across the EU. Fifth point, around marketing. Investors are often influenced by the first piece of information we see. And that's increasingly taking place online, especially, as I said earlier, on social media. Misleading marketing can cause great harm, and we do want to make sure consumers are aware of the risks, so they do need to be protected, including in this digital space. So investment firms will remain liable for any marketing done on their behalf, in particular by so-called finfluencers. And adverts will have to be fair, clear, and not misleading. Sixth, to a point that I really hold very dear, which is financial literacy or financial well-being or financial awareness, or being financially savvy. Here we're encouraging member states to introduce national measures to support financial education. And this does not mean that we're expecting everyone to be experts in financial services. Indeed, I am not one of those who are an expert, but I am able to ask the right question. And that's what I would like to see our citizens from a young age upwards being able to do. So we do want people to have the knowledge and the confidence and the awareness to make decisions that meet their financial needs. And finally, on the area of supervision. Here we're looking to improve the cooperation between different national competent authorities, in particular to make sure that a provider offering a service in a different member state is supervised effectively. So I hope that that's given you a flavour of the breadth and ambition of this strategy. It is a bold, in my view, and meaningful improvement on what's currently in place, and it will stimulate retail investment in EU capital markets. Now, moving beyond the strategy itself, we have other initiatives that will benefit consumers, including a proposal just adopted on withholding tax. We recently published a study that showed that 70% of retail investors don't claim withholding tax refunds because it's simply too hard, too expensive, and it takes too long. So one of the goals of this proposal is to make quick refunds and relief at source much easier. Payments, as we all know, have a big impact on the consumer. Just last October, we adopted a proposal on instant payments. And here we want people to have more control over their payments and to avoid the risk of late fees or penalties. We also want that in emergencies, people can quickly receive funds and that we can enjoy the same seamless payment experience anywhere in the European Union. And finally, building on open banking. Next week, we will propose rules on open finance, the Financial Data Access Framework. And this is about putting the customer in control of their own data. Put very simply, we want to make sure customers know what data they're sharing, with who they're sharing it with, and indeed why the information is being shared. And this would help them make informed decisions about sharing their data. At the same time, the rules will enable companies to provide new products or services based on data that is shared. and companies accessing data will be regulated and supervised. So it is an area that provides great opportunities for better and more targeted products for customers. So in closing, there is no reason that that scenario, that dream that I just outlined earlier about retail investment cannot become a reality, where everyone has access to a wide range of products and services that suit their needs and meet their expectations, and where they get fair and cost-effective financial advice, and that they have rights and protections when they make these decisions. And they have the knowledge, the tools and confidence to make their money work for them. So we are at the start of this journey towards a much better retail investment ground. We will need the cooperation of the industry, but we very much value the voice of the consumer that Better Finance brings to the table. But also it matches my commitments when I took office to put the retail investor, to put the citizens at the heart of the financial system. Because finance matters. It particularly matters where your resources are very limited. But the whole financial system is the backbone of a thriving society and economy, including in our transition to be a more green and digital European Union. And also it's important to reflect that evidence would show that those who are financially literate, who have the skills and knowledge, not only do they have better financial outcomes, but they tend to have better health outcomes, because there is nothing that will make you ill quicker than financial woes. And I think we saw that during and after the financial crash. So you in this room and those who are part of the financial system, as I am, have a really important duty in society, beyond the financial system, to get this right. But I'm sure we will. Thank you.
So thank you so much, Commissioner, for your speech and for the kind words to the work done by consumer organizations, especially Better Finance. The Commissioner has little time and has asked me to be the conduit of maybe 1 or 2 questions.
If the first one's too difficult, it's only 1, but yeah, 2.
Okay. So the first one is on financial literacy, because you insisted a lot in your speech and also in your former actions on financial literacy. But we are always intrigued about this, because this has been a recurring issue in the past. First, because the European authorities have no competency for children education, and second, because we believe that you will not get adults back to school, especially on financial matters. Well, we love financial matters, but are not so maybe exciting for the man in the street. So what is your vision about this, especially also as the only way they are educated right now, or let's say the main way, is the retail point of sale, where still, I must relate to the other points you made, still it is what MiFID calls non-independent advice that is dominant, and can that fit with financial education?
Well, look, you could say that the glass is either half full or half empty and be quite pessimistic, but I'm quite optimistic. Those member states that I've had lots of conversations with about financial literacy are really interested. They want, because they know the benefits of having citizens that are savvy about money. So I don't think there's a resistance. And if I look across the banking system and financial institutions, there is a lot happening there. But I think we need to analyze why it's not having an impact in terms of lifelong learning. So I think that for me, it would be to achieve a situation where before I go into the room with an advisor, that I know what I'm going to ask. And I know that if I don't understand what is being said, that I can say, excuse me, could you explain that again? Very few of us do that, because we usually just listen, and we're not proactive enough. I'm from a different stable because I was a journalist, so I always ask questions. So I don't see it a concern that Europe hasn't the competence around education. I see that there is a willingness across our member states. And in fact, I think in this digital era, where those young children starting school now or going through school, this is what they're working from, except it's much smaller. Many of them will not be using paper to get information. And therefore, there's a particular requirement on us to understand the speed at which people are scanning, maybe not reading or taking in, but they're scanning and clicking. And that's why there's a generation, and I think it's true even if you look at gambling, where young men are tending to have apps, and even when it comes to cryptocurrencies, are making these transactions, maybe without thinking about what are the consequences. So I think collectively we have work to do. I don't think we'll ever be finished with this work because it's a work in progress. But when I talk to those agencies and bodies that work with those more vulnerable in society, vulnerable groups and vulnerable families, and when I see the impact of supporting people around the financial piece about loans and interest rates and looking for better offers and how you manage your finances, the benefits of being financially aware, even on the small things, are enormous. So I will never give up mentioning this issue in every speech I make because it matters. And I think Europe has a huge opportunity to lead in this area as we do in many other places. But perhaps we need to keep saying, maybe to our children as they grow up, engage with the financial system early. Don't leave it too late that when you're buying a product, you kind of go, oh gosh, what do I need to get? Mortgage protection, what is that? Do I have to accept what I'm being offered? Most people do without asking questions. So again, I don't want people to be experts, but I want them to feel that they have some element of control. I won't use the expression take back control because that was used in other contexts. Thank you. But I do think there is a need for us all to feel that we have the right to ask even the most basic of questions. And indeed, I have often discovered that if you ask an expert the most basic of questions, not all of them have an answer. Question two?
Thank you very much. So question two, we were very interested in the talk, the answers you gave at the press conference announcing the proposal for a retail strategy. And about the review clause, you said, which we fully agree with, that the Commission will look at first the evolution of retail participation into capital markets and also at the evolution of the cost of retail investing. However, we don't find this yet in the wording of the proposal. So what's your, how to ensure that these great comments of yours ensure that they become reality?
Well, firstly, I know you'll keep me on my toes, so that's appreciated. Secondly, we have to gather information to make an assessment. I mean, we don't want this strategy to fail. So we need to gather evidence, and we need to be able to say if it's not working, why is it not working, and take more action. So this is a proactive approach, because we started discussing retail investment some time back. We looked at the extreme of the introduction of a ban on inducements. We listened to everybody around this, and we didn't resile from it as a possibility, so it remains there, and the industry, I think, understand very well, because I speak quite clearly on this point. But we will give time to see what happens. But you have to gather information. So we will have to look at costs and the evolution of costs. We will have to look at the penetration. We will have to see if new products are being developed. And I think it's in the interests of the financial sector, not just to wait until this goes through the legislative proposal, but start now. Because you can, in a way, increase your business by being more consumer-centric and looking at what options there are for people of different means and different groups in society. So mark my words, we will measure and we will respond.
Great. Thank you very much.
Thank you very much.
That confirms what we wanted. I'm not including words, so I will let others accompany. So that is very near the closing of this event. And after the Commissioner, I will not keep you long. And I will not do what you do in closing speech, is to try to summarize the speeches and the panels. It's my duty, of course, to start, and my role and my pleasure to thank all the speakers who were great and all the contributors to the costs of this event. First, the European Union, but also Allianz, I hope I don't forget anyone, Allianz, Vanguard, Schroders, Deutsche Börse, Trade Republic, NASDAQ, and please shout if I forgot one. But the European Union first. Just one word, because the Commissioner talked about the future. So first there is this review clause, and there is the round table that, of stakeholders she said she would convene. Usually, you know, and that's what John Berrigan said at the very beginning, like the usual, everyone is disappointed by our proposals. And that is because all of us, whatever stakeholder we represent, we look at the glass half empty rather than the glass half full. Exceptionally for you, and I know there are a lot of industry stakeholders in the room, I would like to look at the glass half full. And I would like to just give you one example where I think if there is this roundtable, if there is opportunities to have a better, stronger, higher quality dialogue between consumers, clients, your clients, and the industry, and of course the policymakers. Very shortly, the gentleman from Allianz in the first panel mentioned two things they had been doing now for a while. First, that for complex products such as insurance contracts, unit-linked contracts, but also personal pension products, they go through independent saver associations to subscribe on behalf of the savers. That reduces the asymmetry of information, and that is also enabling savers to have more say into monitoring and also the governance of these complex products. So that's one thing they have been doing. And the other thing, they said that, and I can confirm it's true, that recently in all their unit-linked insurance contracts, there are only now clean share funds and ETFs. So that's just an example. And I rarely, praise, especially pointing to someone, industry players, but you are doing great things. So I think there is room for discussion and for more cooperation between the representatives of the various stakeholders. And so I'm looking forward to the future with less biased advice, more participation of retail investors into capital market, and decent returns, especially for our financial well-being and for our pensions. Thank you very much.